There is a sense, I think, that the markets are increasingly worried about some kind of fiscal risk.
Companies are just a little less optimistic than they were a few quarters ago.
The issue of the year has really been whether we would broaden out, and I would say that is happening.
When you look at equities, we're going to get growth, right? So, forward returns are just going to be much more muted.
Corporate America is sitting there saying, I'm in a pretty good position. The economy's doing well.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City, let's get you to the weekend. From New York this morning, good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now with equity futures positive by 0.2%. Coming into Friday, poised to snap a 6-week winning streak, but looking to add some weight to yesterday's rally, with the Nasdaq up by 0.25%. Thank you to Tesla for yesterday's rally. This move is just unbelievable in the last 24 hours. A 22% move, the biggest since 2013, a $154 billion market cap move in a single session. As Ollie Crook said out of Berlin a little bit earlier this morning, bigger than the combined market cap of VW, Stellantis and BMW.
And all roads lead to China, whether or not it's the industry growth, as you're seeing in Tesla, which had a completely blowout quarter when it comes to China. Dan Ives yesterday talking about that's going to be the growth driver for this company. But for everyone else, it's the downturn. It's the slag. You look at BMW, look at Mercedes falling off a cliff in terms of deliveries of things like the S-Class, the Maybach, the things that used to be really insatiable for Chinese luxury market. Now no one's buying them. They're going to EVs. And if you're going to go for an EV in China, it's either BYD or it's Tesla.
It goes beyond the automakers. We saw this with Starbucks earlier this week. We saw it with LVMH just last week, saw it with Kering and Gucci as well. Next week's Apple. I just wonder if Apple can buck the trend here with this weakness out of China.
Well, it comes at a time when there's some reporting that Apple has been able to at least get some of these deliveries. There has been some demand on the new iPhone. And also, Tim Cook is in China. What is he doing? He's going out with, local social media celebrities, going out into cities, and on WeChat, taking these selfie videos, talking about the fact that he wants to maintain this presence and he wants Chinese consumers to go out and buy iPhones.
Big week for tech earnings next week. We'll talk about Apple a little bit later in the program. The single name we've got to talk about right now, Capri. Check this out. This move, this stock, getting cut in half. We're down by 47% in the pre-market. The regulator wins, a federal judge blocking Tapestry's $8.5 billion acquisition, citing harm to competition in the accessible luxury handbag market. Sometimes the jokes write themselves.
So what's interesting about this is, one, I didn't even realize there was this accessible luxury market. And if you're Versace or if you're Jimmy Choo, are you looking at this saying, are we really accessible luxury? I thought we were supposed to be primetime luxury. Also, why is this a market that needs to be protected so much? A lot of people are going to get burned on this. David Einhorn even wrote in his note that he thought that this would go through. Potentially, why would they want to break this up? It doesn't seem like something that is really anti-competitive, and hedge funds took on more of these positions of Capri, which is now in free fall.
If this can't go through, what does it mean for Albertsons and Kroger? And what does it mean for anyone trying to put an acquisition together over the next several months? I imagine they're not going to bother. We heard from Brian Moynihan of Bank of America earlier this year, and this is what he said. Ultimately, holding back acquisitions, a lack of clarity about what it would take to actually get a deal done. What would they allow and what won't they allow?
That's a good question, and also the election. FTC Chair Lina Khan, already her term is actually up. She still stays on until there's another president. She can either get another term under Kamala Harris, so there's a lot of debate within the Democratic camp. Some of the billionaire donor class do not want to see her at the top of the FTC, and others like Alexandria Ocasio-Cortez, the congresswoman from New York, who says there'll be an out-and-out brawl if anyone tries to touch her position. But what about Donald Trump? This is the one individual, Lina Khan, that J.D. Vance actually thinks is doing a good job in the Biden administration.
Capri Holdings getting absolutely hammered in the pre-market. Let's get to the cross-asset board. I said equity futures were a little bit positive this morning on the S&P 500. Check out the bond market. Giving equities a helping hand. Yield to lower by a single basis point. The 10-year, 4.1960. The 2-year, down about 2 basis points on a 2-year, 4.06%. Looking ahead to the payrolls report. Sneak peek of our survey. The estimate, the median, comes down to 120. 120 is the median estimate in our survey. We'll be talking about payrolls a little bit later this morning. Coming up this hour, we'll catch up with Jim Bianco of Bianco Research as traders look ahead to the US election. Ed Mills of Raymond James as Harris and Trump head into hostile territory. And former IMF First Deputy Managing Director John Lipsky as the IMF's annual meeting wraps up. We begin this hour with the S&P 500 heading for its first weekly drop in 7. Traders dialing back bets on Fed rate cuts and weighing election risk. Jim Bianco of Bianco Research looking to the betting markets for clues on the election outcome, writing the power of the betting markets is that they can react quickly to new information, such as a political event and/or an October surprise. Trump is trading in all markets greater than 50% and has been in an uptrend for weeks. Jim joins us now for more. Jim, welcome to the programme, sir. Let's start with the betting markets and compare and contrast them with what you're seeing in the polling data. How big is that spread?
It's not very big at all. Most of the polling, most of the election modelers have got Trump slightly above a 50% chance of winning the election. The betting markets are supposed to take that into consideration and anticipate what's coming next. As you mentioned, Trump is in an uptrend and has been in an uptrend, and he's trading in the low 60s in the betting market. And so that seems to be appropriate. And the reason I bring that up is if the markets are manipulated, you would say that they're at some unexplainable level. But I don't think that these markets are at an unexplainable level. And the last thing I'll point out is these are probabilities. These are and probability of 60%. A lot of people have a hard time getting their head around what that means. And I've used the analogy that it's less than a 3-point lead in a football game, and a stop and a field goal by Harris could win the game. So it's not that hard to turn it around. But Trump is leading, and the betting markets seem to be appropriately priced.
Jim, when it comes to the betting markets, though, we know there's one big outsized, almost whale when it comes to this French trader. Is that potentially why we see Trump moving ahead, just because there's these outsized moves in the betting market where it's not going to pick up in the polls?
Yeah, no, not really, because there's 10 betting markets. They're all kind of saying the same thing. The volume in the betting markets has doubled in the last week. It will probably double again next week. It always does in the final days before the election. There's going to be probably more whales that come into this market as well, too. It really looks like it's somebody who's got a strong conviction and put a lot of money on that conviction as opposed to a manipulator. And that's why I say that if you look at the polls, you look at the election modelers, where should this market be trading? About where it is right now. So it seems that everything's appropriate.
Do you think that financial markets are looking more at the polls or at the betting markets?
You know, they both kind of look at each other, because there is, whether you're talking about Trump media, DJT, or you're talking about Bitcoin, or if you're talking about the defense stocks versus the technology stocks, they've all got some kind of embedded election play in them, and they're all kind of feeding off of each other. The bettors are looking at those markets are looking at the bettors. And so it's kind of a reflexivity that you see going back and forth between those markets.
So, Jim, we need to talk about how well priced the Trump presidency and/or GOP sweep might be. And with that in mind, and I've seen this a lot from the fixed income side, from a lot of strategists, asking themselves whether risks are skewed asymmetrically to lower yields because of how well priced the Trump presidency might be. How are you thinking about the balance of risks into the next few weeks?
Well, I think still the balance of risks is still going to be higher, because if we were to get a Trump presidency, and again, it's not a lock, you'd be looking at tariffs, and that's a form of inflation. You'd be looking at tax cuts. That's a form of stimulus. And you'd be looking at an economy that is going a lot stronger. And I think what the bond market has been bothered by has been the Fed moving 50 basis points in September. It's not 50 that bothered them. It's the signal, as Austin Goolsbee, the Chicago Fed president, said, that they've got hundreds of basis points to go. And I think the bond market's looking at this and saying, well, if we're going to get tax cuts, we're going to get potentially more inflation through tariffs. We don't need hundreds of basis points of rate cuts. That's just going to be piling on to potentially create more of a stagflationary type of environment. And that's why you've seen the 10-year yield move up 60 basis points since the day the Fed cut rates on September 18th. It hasn't bothered the stock market yet, but I think at around the 4.25 level is really anything above that is where the stock market really starts to run into problems with the rise in rates.
Jim, let's build on that. 460 that morning on September 18th, as you suggest, 60 basis point move. If you believe the path of least resistance is still for high yields from here, what kind of numbers are you thinking about?
Well, let's look at some of the numbers in the past. In April, we hit 475. October of last year was the high since the pandemic, where we hit 5%. I think we could probably go back and at least revisit some of those numbers, probably in the first quarter, if we do see this burst of activity come through tariffs, through a stronger economy. And let's not forget, whether who wins the election or not, that the economy has been picking up steam in the last few months. And now with the hurricanes and the strike, I heard you mention the payroll report, all that's going to get muddied for the next few months as we try and figure out what the path of the economy is going to be. But it was picking up before that. So all of that does augur for much higher yields. And that's why I think we could at least go back to the April highs by the first quarter, if not, press that 5% level that we saw last year.
Jim, let's get to the jobs numbers next week then. NFP about a week away. 120 is the median estimate in our survey. What's curious about this moment in the labour market is that jobless claims came out yesterday, back to pre-hurricane levels. And Jim, I'm trying to work out if the risk for next week is actually a stronger number, stronger than some people are expecting. What are you looking for?
Exactly that. I was very surprised by the claims number 2. If you look at it during Katrina in 2005, or Hurricane Harvey in 2017, which came ashore in Houston, the claims numbers jumped 50,000, 75,000, and gave you a clue that you were going to see a very depressed payroll report. In both of those instances, the payroll report was negative for that month on the first release. But you're right, the claims numbers have actually returned to where they were pre-hurricane, returned to where they were pre-Boeing strike. I'm sure there's a lot of suppliers that are laying off now with the Boeing strike, returned to where they were pre-Stellantis layoffs that happened a couple of weeks ago. And that does open up the possibility that we might not see any weather impact in these numbers, and maybe a bigger number that might be truer reflection of what the economy is saying at a time when we didn't think that those numbers would show us a reflection of the economy.
Jim, is there a number in mind that you have that would put the Fed on pause?
On pause for November 7th, probably not. I mean, the market's, priced 90% chance that the Fed is going to move, and they've got 1 week before they go into their quiet period. Even a strong number, if it's another 250,000, I don't know if that would be enough to get the Fed to pause on November 7th, but December would be open for a pause, even if they were to move in the next 2 weeks.
Jim, I think that is the question. What would it take to get WikiLeaks to write an article to say that maybe this wasn't going to happen? Jim Bianco of Bianco Research. Jim, it's good to catch up with you, sir, as always. I mentioned the 120. That's the median estimate in our survey. Let me give you the low. The low is 70K in our survey. Wolfe Research, Stephanie Roth, joining this programme a little bit later. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. As you were discussing this morning, shares of Capri Holdings are plunging 46% pre-market. A federal judge blocked the company's planned $8.5 billion takeover of Tapestry. The judge said that allowing the owner of Kate Spade & Coach to buy the Michael Kors and Versace owner would harm competition, creating a company with 59% share of the accessible luxury handbag market. The ruling is a major victory for FTC Chair Lina Khan, who has tried to sink takeovers deemed anti-competitive in sectors from tech to groceries. Elon Musk has donated more than $130 million to support Donald Trump and other Republicans. Musk, who had only given modest political donations until this election cycle, funneled nearly $44 million to his America PAC in the first half of this month. That brings his total to $119 million. He also spent millions on other GOP candidates, helping him build a network of allies. Fast food chains are pulling onions from menus in several locations due to the risk of E. coli. Burger King and Yum Brands, which owns KFC, Pizza Hut, and Taco Bell, have removed onions from some stores as a precautionary measure. An outbreak that led to dozens of illnesses and one death were traced to onions found on Quarter Pounders in McDonald's. Burger King said that some of its onions are sourced from the same Colorado facility that supplied the affected McDonald's restaurants. And that's your brief. John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the programme, heading into hostile territory.
It's the attention war. You have to win the news day. And doing a big rally at MSG or doing a big appearance potentially with some sort of celebrity maybe in Houston is a way to do that.
We'll talk about that strategy up next on the programme, live from New York City this morning. Good morning. Equity futures on the S&P 500 up by 0.25%, poised for a weekly loss. We're down 0.9% through Thursday, looking to snap a 6-week winning streak, the longest weekly winning streak of the year so far. Up 0.25% on the S&P, down a single basis point on a 10-year, 419.60. Under surveillance this morning, heading into hostile territory.
It's the attention war. It's the attention war. You can go to Wisconsin 20 million times. You can go to North Carolina 20 million times. But these closing weeks of the election, you have to get into people's living rooms. You have to win the news day. And doing a big rally at MSG or doing a big appearance potentially with some sort of celebrity maybe in Houston is a way to do that.
Here's the latest this morning. Kamala Harris and Donald Trump heading deeper into their opposition's backyard in the penultimate week of the election race. Trump gearing up for a rally over the weekend at Madison Square Garden, with Harris heading to Houston, Texas, as both candidates look to grab attention in the last few days of the campaign. Ed Mills of Raymond James writing, the recent shift in sentiment and polling appears to favour former President Donald Trump. But given the surprise results of recent elections, we continue to view the presidential election as a toss-up. Ed joins us now for more. Ed, welcome back to the programme, sir. Let's talk about this trend of going into your opposition's backyard. How powerful do you think that effort is?
So, John, I think it's an important way of trying to nationalize the race in the final days here. Going to Texas gives an opportunity to give the Senate candidate that is challenging Ted Cruz, Allred, a boost of support. But it also gives an opportunity for Kamala Harris to talk about abortion. We're going to see her next week on the National Mall. She is in the early stage of making that closing arguments for former President Donald Trump. What we're going to see is this stadium tour trying to show that his movement is truly national. So we have had a huge focus on the swing states, but in the closing days here, I do think you try to nationalize the race, make that closing arguments, and try to have that attention in all states and try to see if you can go on the offensive. See if there's some state that doesn't seem to be on anyone's map right now that could flip. We saw that in 2016. We saw that in 2020. Will we see that again here in 24?
For Kamala Harris, Houston makes sense because she's going to be joined by Beyonce. And as you say, she wants to talk about this issue of reproductive rights. It's one of the states that has one of the most stringent abortion rules in the country. But why is Donald Trump once again in New York? He was in the Bronx earlier this year. He was just in Nassau County. Why the Garden?
Well, there are a number of things about the Trump campaign that I would not always say this is a traditional campaign. I do think he does want to have this rally at some of these major kind of venues, showing that there's enthusiasm. And I think part of what they've tried to have from the Trump campaign is saying that this is a movement that's national. And even though there are some states that they are exceptionally unlikely to win, there is a strong base of support. New York is also critical for the race for the House of Representatives. We look at New York, we look at California. There are 8 Republicans in toss-ups districts. If Harris is able to mobilize her base, she's probably going to see the Democrats win control of the House of Representatives. If Donald Trump is able to stabilize and kind of get his base out on Long Island and some of the close-in suburb districts in New York, maybe a couple of those Republicans hang on. Maybe Republicans hang on to their House majority.
Ed, you mentioned the Texas Senate race. This is Ted Cruz's seat that he is defending. This morning, I was looking at polling. It's Republican-backed, but they do some good polling. The Senate Opportunity Fund. They now have Nevada, Rosen and Brown tied. What are you seeing in some of the down-ballot ticket races?
They're really, really close. And I think what we have seen in Nevada is a consistent lead for Senator Rosen throughout this cycle. But with the early voting coming in Nevada, there's been a tilt to Republicans. At least that's what the nonpartisan prognosticators out there and some of the press that do a great job in Nevada kind of following that. So they're seeing a tight, maybe slight lead for Donald Trump in Nevada. So investing a little bit more, seeing if Sam Brown, the Republican contender, can maybe catch that seat, even though he's been down the whole cycle. At this part of the game, it is also a bit of a chess match between these campaign committees. Making a couple $1 million investment in one seat is trying to get that last push from donors to say, oh, we're on the offensive. people like to be with the winning team. And so the more you're on the offensive going into the final stretch, the more you can get your donors to pony up. Donors don't like to give money if they think the campaign's losing. And so, it's probably part of a national strategy by both the senatorial campaign arms, the Republican and Democrats, to say that there is an offensive opportunity. Is it for Texas for Democrats? Is it for Nevada for Republicans? Some of this is a little bit of bluffing at this point, but we have to wait till Election Day to see whose bets were actually the correct bet to make.
Ed, let's talk about that. How long it's going to take to actually find out the answer to some of the questions we have. One thing we know is that it will take a long time to count some of these votes. Ed, what are you telling clients about when you expect to actually see a result to this election?
So, John, my hope for this election and my hope for the markets is that what we've gone back and we've looked at many past elections, and while we are at 50-50 in the presidential race, and we look at a number of these cases in the Senate where those are kind of toss-up, which implies 50-50, they tend to all break in one direction. And so if we do have 7 swing states, we could see it break 5-2, 6-1 in the end. And if we are seeing that break in that direction, we will know probably early on kind of Wednesday morning after the election, kind of largely who's won. If it comes down to one state, that could be a week, that could be a couple of a month or more before we know who that is. I don't want to have that happen. Pennsylvania was called Saturday after the election. Nevada was called Saturday after the election. It was 16 days before North Carolina was called in the 2020 election. I don't want to be waiting 16 days. So my hope is that we do have a decisive break on Election Day, and it'll be pretty clear election night, if not early Wednesday morning.
At the most important county in Arizona, Maricopa County, their officials are saying it could take 10 to 13 days. What if this comes down to Arizona?
Well, that's the deciding factor where it's like we did look back into 2020. We put out a note with a number of clients at Raymond James have been asking us, when will we know? So we get a chart of every single state that we got the calls. And it was interesting that most of the kind of swing states that are being discussed this year were called Saturday or after the election. My gut tells me that we probably will have a clear kind of direction on election night, if not early on Wednesday. It probably will take until a week or more for the final certification of these results. We just don't want to be back in the 2000 land where it gets litigated or we have election denial 2.0 because we have different vote counting methods, which kind of will favor one candidate early versus the other. There are blue mirage states. There are red mirage states.
Is there any concern that it might take days for some of the down ballot seats?
Yeah, I mean, I think we could be in a scenario if it's a very close House of Representative race. New York and California, as I mentioned, are 2 states that could determine the outcome of this majority in the House of Representatives. New York and California are really slow to count votes, especially on absentee ballots. And so they're not normally swing states. They're not going to be swing states at the presidential level, so they don't get the attention. But on some primaries where they have gone into kind of a very close final count, it's been weeks at times before we know the final result of some of those House races. It's arguably unacceptable, but that's just the reality of the way their systems are set up. So we probably know kind of the result of the presidential election before we know the result of the final House and Senate races for 2024 here.
Ed, we all agree with you. The fact that this has been such an issue for such a long time and still hasn't been addressed is unacceptable. Ed, thank you, sir. Ed Mills of Raymond James there with the latest. The number one issue for market participants, obviously, the result. The number 2 issue, the delay. If we get a delay, that's a big focus for a lot of people in this market.
Well, Maricopa County is one of those issues. This is a county that has millions of people in terms of population, 10 to 13 days. What if it comes down to that? We're going to be here for a while.
We're going to be sitting up all night and waiting for that? We're not. Let's get you an update on what's happening in D.C. Up next on the programme, Lisa joins us alongside the former IMS First Deputy Managing Director, John Lipsky. That's on the other side from New York. This is Bloomberg. Coming into Friday, poised to snap a 6-week winning streak on the S&P 500. Equity futures this morning positive by about 0.25%. Down on the week through Thursday by 0.9% on the S&P. On the Nasdaq 100 this morning, up by 0.3. On the Russell, a bit of outperformance, up by 0.5. Let's talk about the moves in the bond market. The 2-year and 10-year through yesterday, up by double-digit basis points through the week so far. We pulled back just a little bit, down a basis point, the 10-year 4.1980, the 2-year at 4.06. The next stop for this market is a week away. It's the payrolls report, and the estimate in our survey is 120. A lot of people lowballing the jobs number next week because of the hurricane impact, but jobless claims, I think, really screws some of the thinking up. Jobless claims dropping back to the pre-hurricane levels, and this is what Stephen Stanley of Santander had to say. The impact of Hurricane Helene seems to be dissipating more rapidly than feared, which is a positive sign that the economic impact of the hurricane is not mushrooming through the region. Your 10-year, 4.1980. Let's get to foreign exchange. Sneak peek of the euro, then we'll dig deeper on dollar yen. Let's start with the euro. Euro dollar 108.26, just about unchanged. Dollar yen looking at 152. Dollar yen climbing for 4 consecutive weeks, the longest streak going back to April. We went through 153 a little bit earlier this week. Under surveillance this morning, the Bank of Japan Governor Kazuo Ueda signalling the central bank won't hike interest rates next week, saying the BOJ has time to consider its next policy steps, even after the yen fell to an almost 3-month low.
So that decision is coming between 2 elections, one at home in Japan for them, and then the U.S. presidential election. And Ueda spoke about this. Quote, "We need to look at the whole picture, diligently examine impacts on Japan's inflation from not only a weak yen, but a view on the U.S. economy behind it, which may be related to the U.S. presidential election." They don't want to touch this until they have the outcome in both the United States and in Japan.
The week of the Federal Reserve decision back on September 18th has turned out to be a really pivotal week for this market. They reduced interest rates that week by 50 basis points. And the consensus on the street was that we'd seen peak yields, we'd seen peak dollar, yields would roll over, the dollar would weaken, and yen strength would continue. Dollar yen bottomed 2 days before that decision at 140. Since then, yields are up by something like 60 basis points and dollar yen's back to 152. These are some big moves.
These are some big moves. And the problem is it's not just the economics that people are starting to price in. People are starting to price in the outcome of the U.S. presidential election. Yes, the polling is on a knife's edge. When you look at the betting odds, we just talked about this, Jim Bianco, they're looking at not just a Trump win, potentially a red sweep, and that is trickling down into the financial markets.
Dollar yen, 151.97. Anne-Marie, I think we all want your thoughts on this story right here. The Wall Street Journal reporting that Elon Musk has been in regular contact with Russian President Vladimir Putin since 2022. Putin reportedly asking Musk to avoid activating his Starlink satellite internet service over Taiwan as a favor to Chinese leader Xi Jinping.
So that was the line that stuck out for me. We know that Elon Musk has been in contact with Putin, at least one conversation. Musk has said that in October of 2022. The fact that there's maybe more conversations, that is going to get the backs up of a lot of individuals in the national security space, even though they technically understand that Musk has this really outsized place in U.S. society because of the contracts he has with the Pentagon and SpaceX. But the fact that Putin asked him not to activate Starlink over Taiwan as a favor to Xi Jinping, now that means that Musk is not potentially helping or in contact with one individual that's a U.S. adversary, Vladimir Putin, but a second potentially, Xi Jinping. That is going to be a cause for concern.
Interesting timing for this to come out a week before the U.S. election at a time when Elon Musk has been campaigning pretty closely with the former president.
Very closely, and also at a morning when yesterday we got fresh data on how much money he's throwing his support behind the former president. It's now something like $150 million for the president and also down ballot Republican races. Not only that, he's not just throwing support around the individuals that want to seek higher office. He's also talking about $1 million apiece for registered voters, which apparently those checks have gone out, even though the DOJ has a warning to Elon Musk saying this might be illegal. Stop doing it.
That's the latest from the Journal this morning. Let's get to the latest in this equity market. 2 stocks to watch. A federal judge blocking Tapestry's planned $8.5 billion acquisition of Capri, saying the deal would harm competition in the market for accessible luxury handbags. Capri is down by 47% in the pre-market.
2 thoughts. One, we need to understand what accessible luxury is. I think Donatella Versace would disagree with the the FTC. I want to bring you this quote from an individual at the FTC. These bags are a product which millions of people rely on throughout their daily lives. The decision will ensure that Tapestry and Capri continue to engage in head-to-head competition to the benefit of the American public. Think about that. Millions of people rely on throughout their daily lives. Do millions of people actually rely on a Michael Kors handbag, a Coach handbag? Honestly, are they serious?
This can't get done. JetBlue deal can't get done. Kroger's looking to make a deal. How is that deal going to close if this can't get done?
Nothing's getting done. Don't even try until after the U.S. election. That would be my advice.
And let's see if we actually get a change after the US election, because that's another debate altogether. I want to turn to the annual IMF meeting. It's wrapping up in Washington, D.C., with the impact of the US election one of the key topics discussed among world leaders.
What happens in the U.S. matters for the U.S. and matters for the whole world. The U.S. economy is very strong right now. At the same time, we are seeing inflation coming down, and our expectation is that it will continue to do so, and the Fed will continue to cut rates. Now, if there is a much more expansionary fiscal stance, that could move the argument in a different direction.
Joining us now from the nation's capital, Lisa, alongside a special guest. Hey, Bramo.
Hey, how's it going, John? I am indeed here with the person who formerly was in the role that Gita was in. That is John Lipsky. He is currently a distinguished scholar at Johns Hopkins and was at the IMF from 2006 to 2011 as that first deputy managing director. I am curious, especially relative to what she was saying, Gita, how much is the election hanging over these meetings with people not really understanding what to even say about it?
Exactly. We know it's potentially an important inflection point, depending on which way U.S. policy goes in many areas. However, there's so much uncertainty about the outcomes and what a winning candidate might actually do that no one really knows what to say.
Which is a reason why I think a lot of people are having trouble coming up with paradigms, especially given that free trade used to be one of the benchmarks to really understand the pace of growth and the potential of growth. As there is this increasing acceptance of protectionist policies, how much is the IMF just screaming into the wind, sort of trying to just ascribe to these free trade policies that nobody really is listening to?
Well, it's a complicated issue, but let's start the following way. Let's look at what's been happening. Actually, there was an inflection point at the global financial crisis. At the formation of the Group of 20, the leaders pledged no new protection measures. And in fact, they haven't honored that. They've increased protection. For the 60 years prior to the global financial crisis, trade grew faster than global GDP. In other words, trade boosted growth. Since that time, trade has been growing more slowly than GDP. And even now, with all the increased protection so far, trade in goods has flattened. Trade in services is growing, and digital services trade is booming. So it's a complex story, and hence the real issue is, are there going to be really serious protectionist measures put in place more generally? And this would be a huge challenge to the international system. For the IMF, if you look at the Articles of Agreement, the constitution of the fund, and say, what are the purposes of the fund? Top is creating a payment system that will support the growth of global trade and hence global growth. Secondly, to provide support of all kinds, including financial support, to countries with balance of payments problems, so they will to help them avoid adopting protectionist, among other things, protectionist measures.
So if one of the major members of the IMF, namely the United States, ends up putting in place a number of these protectionist policies, what is the IMF's role? How much does that undermine its relevance?
Well, the IMF will certainly have something to say about policies like that. So far, as I say, the trade is still actually growing. So far, there's been more talk. Obviously, there is real and legitimate concern as growing out of the pandemic in terms of resilience of supply chains. There's concern about national security, et cetera. Those are going to have an effect. But it's so far unlikely that anyone is taking measures that are seriously disruptive to the system. And of course, the interconnections among our major economies are so deep and so thorough, it seems very hard to be able to disrupt them without disrupting the economy.
And this is one reason why, even though we hear a lot about the separation of Chinese and U.S. economies, we still hear from businesses that are expanding in China. We still hear about significant revenue streams that are taking place there. At the same time, while these IMF meetings are taking place, there is a meeting going on in Kazan, Russia, where you have Brazil, you have Russia, you have China, you have Vladimir Putin and Xi Jinping and a lot of the different delegates from Russia and China there, not here. How significant is that?
Well, of course, those are the political leaders. And here in Washington, all the finance ministers, all the central bank governors, including of all those countries, are here in Washington. And nobody's talking about withdrawing from these organizations because, in fact, in practice, they're critical gathering places, critical place for discussions about important policies. Now, certainly, it's not a coincidence that the leaders of the BRICS, the new expanded BRICS, are meeting at the same time. I think they want to send a symbolic message that says we need and deserve a bigger voice in the international system. What they're not talking about is withdrawing from that system in any serious way.
The other issue that's really been talked about here is the deficit. As people are watching the U.S. deficit expand, and the U.S. only benefit from it in terms of faster growth, is there a sense that it is for now, and that in the election, after we get the results, there could be a real reckoning in a material way?
Well, you never know. What the IMF has pointed out in its Fiscal Monitor benchmark publication is the growth in public debt basically everywhere, and we're now reaching levels that have no historic precedent. It's as we soon past 100% of GDP in public debt in major countries, clearly there is a risk of fragility, there's a risk of a negative reaction, and certainly a rise in real interest rates could put a significant dampener on growth. So we have to watch it, but the problem is debt has grown faster than had been anticipated and faster than past traditional lines of where trouble starts. And it hasn't started so far, but it's so far so good. Not that we all know that there's going to be a straw that breaks the camel's back, but in fact, markets do have turning points, and we have to pay attention.
Is it frustrating for people that we're worried about the deficit? You hear all these warnings. It's unsustainable. It's different this time. And then people say, well, look at the market. It's not concerned. Is that concerning to people, frustrating that no one's going to take it seriously until the market really holds Washington's feet to the fire?
Well, not just Washington. That's one of the points of the IMF's Fiscal Monitor. This is generalized. Now, the pandemic, for example, was more or less unprecedented. What you had was a shutdown of the private economy. So government spending was necessary to compensate. It wasn't standard stimulus. It was completely different. So it's understandable that the growth in debt hasn't been as deleterious because it actually supported the economy. But it would be dangerous to assume you can just keep going at a full employment economy with large fiscal deficits and assume there's never going to be a price to pay.
John Lipsky, wonderful to speak with you here in Washington, D.C. Thank you so much for your time. Really appreciate it.
Lisa, it's always a pleasure.
John, I'm going to send it back to you.
Thank you, Lisa. Thank you very much. We'll catch up with you a little bit later on this morning. In the next hour, Lisa catching up with the Citigroup chair, John Dugan. Do not miss that conversation. With an update on stories elsewhere this morning with your Bloomberg Brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Negotiators from Israel and Hamas will meet in the coming days amid renewed efforts to end the ongoing war. Speaking in Qatar, Secretary of State Anthony Blinken said the U.S. is exploring different options to secure the release of hostages held in Gaza. Israel said the chief of its Mossad intelligence agency would meet with the main negotiators for the U.S. and Qatar next week. Fast food chains are pulling onions from menus in several locations due to the risk of E. coli. Burger King and Yum Brands, which owns KFC, Pizza Hut, and Taco Bell, have removed onions from some stores as a precautionary measure. An outbreak that led to dozens of illnesses and one death were traced to onions found on Quarter Pounders burgers at McDonald's. Burger King said some of its onions are sourced from the same Colorado facility that supplied the affected McDonald's restaurants. And sorry, Anne-Marie, if you want to go to this year's World Series, you better be ready to pay up. The cheapest seats at Game 1 at Dodger Stadium start at around $975. Tickets are even more expensive in New York. Demand for the games in the Bronx is about 40% higher than LA, that according to StubHub. Game 3 at Yankee Stadium Monday is poised to be the most expensive ticket in World Series history. The average price nearing $2,000. And if you want to sit behind home plate or above the Yankees dugout, that is going to set you back more than $20,000. And that's your brief. John.
Danny, thank you. $20,000. I knew this would be expensive. New York, I think, has the highest concentration of millionaires of any city on the planet, but $20,000 to sit behind home plate.
It's extortion, and it's unfair. And Mohamed El-Erian, a Mets fan, sent me that story yesterday, basically laughing, because he knows that I'm checking StubHub every single day. But it's ridiculous.
$2K. What's the lowest priced ticket for this?
The lowest price actually is if you go to Los Angeles and watch the game tonight. So it would have to take a flight, but could work. $975.
Okay. Up next on the program, Trump 2.0, haunting global leaders.
Across the board, indiscriminate tariffs would isolate America on the world stage. There's a role for targeted tariffs, but tariffs alone are not a path to prosperity.
That conversation up next, live from New York this morning. Good morning. Quiet morning so far. Equities just a little bit higher. Bond yields just a little bit lower. Equity futures on the S&P up by 0.25%. Bond yields down a single basis point. A break of 420 again, 419.80. Under surveillance this morning, Trump 2.0, haunting global leaders.
Across the board, indiscriminate tariffs. They are going to have 4 predictable consequences. Number 1, global retaliation. Number 2, it's a regressive tax on the most vulnerable segments of society. Number 3, it compresses profit margins for any business that imports components. And number 4 would isolate America on the world stage. There's a role for targeted tariffs, but tariffs alone are not a path to prosperity.
So here's the latest. The former president's potential return to the White House looming large as the world's financial leaders gather in Washington. Officials at the IMF's annual meeting zeroing in on one issue, his proposed tariffs on China and the rest of the world. Lisa's back with us from Washington, D.C. Lisa, give us an idea of the difference between what these leaders are saying publicly and what they're saying privately behind closed doors.
I'm kind of laughing to myself because that's exactly what I was going to start with. Publicly, they say, oh, we don't know what the outcome is going to be. How can we even come up with parameters for what it could look like? And in private, they're saying our inflation's going to rise dramatically. We potentially could see suppressed growth. We're going to have to totally rearrange our entire financial structure. We're going to have to figure out who our friends are. It's a completely different type of tone that really screams of deep concern that this could be a paradigm shift, John, potentially going forward.
Lisa, I saw your interview yesterday with Geeta Gopinath, and she was talking about that what kind of policies come out of the rest of the world depends on important elections without naming which ones, obviously the United States. So what kind of policies are some of these other countries thinking if we get potentially Trump back in the White House?
Well, there's concern about tariffs and what that does. There's concern about whether Trump could pull out of the IMF and some of these major organizations that ascribe to free trade and some of the traditional structures of the financial system. At the same time, it's unclear. And that's what they all say. They don't know what is going to get thrown at them. And one of the big questions is how much does just simply the uncertainty have a whole drag on economic activity ahead of what those proposals could be, even after, say, if Donald Trump is elected. I want to bring in someone who knows vastly more than I do about this, our first deputy managing director Director of Global Economy. That is Enda Curran. I love the titles here, Enda. We really appreciate you being here, and you've been covering the IMF meetings, and you've also been covering the IF meetings. And I would ask John's question to you, who could probably answer it a lot better than I am. How different is the public rhetoric and the private rhetoric?
So no one's mentioning the name, but all the focus here is on Donald Trump in particular, because the spillover for the global economy is his very hawkish rhetoric on trade policies, tariffs, protectionism, industrial policy and the like. So a lot of the officials that we have spoken to are worried about what it will mean for investment in their country, what will it mean for supply lines and production and manufacturing around the world, how serious will Mr. Trump be if he was re-elected in terms of what he's talking about with tariffs, and how would trading partners around the world respond. So a lot of concern and worry here about the prospects for a renewed round of trade tensions if Mr. Trump is elected.
How different is the tone right now, both at the IMF and the IIF, the International Institute of Finance, considering that a lot of the global financial leaders are talking about the need for deregulation, the need for less public interference in what they do?
Yeah. Slightly different crowd, different messages. The public official sector, people here at the IMF are worried about spillover to growth and trade and what it means for economies. Of course, the banking crowd at the IIF, more of a hint there that what's better for markets, what's better for their business in the short term, and of course, which candidate will cut regulations more for them. Again, everyone's being very careful here. It's polite society. No one's endorsing any candidate or naming names, but it's clear in the tone of the conversations, who's worried more about what.
Yeah, and it comes at a time, and this is the reason why I bring this up. On one hand, at the IMF, you have people worried about Donald Trump coming in and getting rid of some of the old order. At the IIF, a lot of people are decrying overregulation that is causing a real stymieing of global business. I think about yesterday's deal that the judge said would be blocked, the Coach and Tapestry deal, the Tapestry and Capri, and a question about what can get done. That was something that John and Anne-Marie were talking about earlier. How much was that a main focus over at the IIF across town in Washington, D.C.?
Well, banking regulation is a focus among the bankers in town here. Obviously, they don't want extra regulation. They want to push back at it at every opportunity they can. So they, of course, are looking at which candidate might be better for their side of business. But I think the bigger picture, I must say, listening to people on all sides of this, the bankers or the official sector people here, is there's still a degree of uncertainty, unknown, just how will the election play out, and then of course how will Congress go, and that will dictate where policy goes. So they all have their favourites in this, they all have their favourite policy picks in this, but there are also a considerable degree of uncertainty as to what's going to happen.
The other aspect of this that I find fascinating is, on one hand, you have people in Washington who are decrying the debt load of the United States, who are decrying the fickle potential policies, the unknowns coming out of the world's biggest economy. On the other side, you ask people, where do you want to invest? The United States. Where is the sort of growth engine of the world? The United States. How conflicted are those two messages?
It is conflicting. There's no doubt, and to be clear, there is focus on debt during these talks. There is a lot of scrutiny on where is the fiscal trajectory going in the US, but at the same time, this remains a magnet for investment. All of the people I've spoken to are saying the US remains wide open for business. It's attractive. It's got a high yield on offer. It's got a flexible workforce. That the sort of this goodwill towards the US economy is certainly a recurring theme of these meetings. But again, it goes back to this point I'm making, Lisa, is that there's also that degree of uncertainty. No one quite knows what's going to happen after November 5. Who's going to win and how will Congress go? That's key for policy.
A lot of robust conversations. Enda Curran, always wonderful to speak with you. And John, that definitely is the tension here. This sort of fear about the United States and, frankly, the envy of the United States given its economic situation.
Lisa, thank you. Alongside Enda Curran, just spot on. This is the theme we've been sort of looking at over the last few weeks. If you export to America, you might have a problem, might have a big problem. But if you invest in America, you might be very well rewarded for that.
Well, where they ended that conversation reminds me of what Christian Leitner, the German finance minister, said yesterday. He said every kind of trade conflict harms both sides. Does it? It's Europe that's going to get hit on both ends. And that's what Gilles Moët said to us. It's the fact that if Donald Trump comes back, 10% around the United States for those exports for Europe is going to hurt. But then the fact that where else is China going to go if the United States puts 60% up? More dumping on the European market.
Europe's got to eat it. Equity futures right now up 0.25% on the S&P. Up next on the programme, we'll catch up with Mohamed, El-Erian of Queen's College, Cambridge, John Dugan of Citigroup, Neil Dutta of Renmac, and Jason Thomas of Carlyle. The second hour of Bloomberg Surveillance. Up next.
When the Fed turns dovish, financial conditions begin to ease. This has been a very strong tailwind just in the last few weeks.
The economy's proving to be much more resilient, suggesting that they really aren't as restrictive.
They're being restricted by keeping rates this high and the curve inverted.
We're just waiting for this very small number of data points that still seem to matter.
When folks say, there are recessionary signals, they are right. When they say the economy is resilient, they are also right.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning, the second hour of Bloomberg Surveillance starts right now with the market board so far this morning just a little bit quieter. Let's start with equities. Your scores look like this on the S&P 500, firmer by 0.2%. Still on course for a week of losses and snapping a 6-week winning streak on the S&P 500. On the Nasdaq 100 up by 0.2%, on a Russell up by a third. Speaking of quiet, some welcome quiet for some of you I know in the bond market. The 2-year, 10-year and 30-year just a little firmer. Yields a bit lower. We're down a basis point. The 10-year 4.1960, the 2-year 4.06%. This time next week, this bond market focusing on one thing. It's the payrolls report. The median estimate in our survey right now is 120. The low is 70. It comes from Wolfe Research. The high is 164. That high comes from RBC.
But Bloomberg Industries is potentially talking about the fact that our economics team, maybe we get a negative print, negative 10K jobs change. Why? No one can really assess what is happening right now. You have Boeing strikes. That deal didn't get done. 33,000 workers out in Seattle are still on the picket line. On top of that, what is the hurricane impact? And then you see the numbers yesterday of the jobless claims. It feels like there really wasn't a hurricane impact. How do you read this jobs market? That's going to be a very difficult one.
With great difficulty. So let's take the claims number yesterday. You're right to identify that as a key point. Jobless claims back to pre-hurricane levels. So what's the risk for next week? For a lower print, bar's already come down. The estimate's 120. Jim Bianco of Bianco Research on this program saying the risk for next week is a stronger number.
What if we get similar to what we saw in September? This blowout potential higher report. What is the line in the sand for the Fed to say, actually, maybe we will go on pause? What if they get a huge number plus no decision from the presidential election when they meet 2 days after?
We keep going back to the calendar. November 1 for the payrolls report, November 5th for the election, November 7th for a Federal Reserve decision. Coming up this hour, your next 60 minutes looks like this. We'll catch up with Mohamed El-Erian of Queen's College, Cambridge on rising gold prices. Lisa will catch up with John Dugan of Citigroup on the banking sector under a new presidency. And Neil Dutta of Renmac expecting weakness going into 2025. We begin this hour with bonds rebounding. The 10-year yield inching down from 3-month highs. This as gold falls slightly from all-time highs. Mohamed El-Erian of Queen's College, Cambridge writing the following. What has been happening to the gold price is not just unusual in terms of traditional economic and financial influences. It also goes beyond strict geopolitical influences to capture a broader phenomenon, which is building secular momentum. Mohamed joins us now for more. Mohamed, welcome to the programme, sir. Always looking forward to rounding out the week with you. This got a lot of attention in the Financial Times this week. Just take it from the top for us. What are you trying to get people to pay attention to? Not just why the move is higher, but what is behind it and how long this has been building for.
And thanks for having me, John. Look, gold is up 32% year to date. That's compared to 22% for the S&P. When we try to relate the moves in gold this year to the traditional economic and financial variables, interest rates, inflation, the dollar, you know them, the relationships have broken down. It has been a very sort of linear move up, and it's something that's continuing for a while now. Then you ask the question, who's buying? And you start getting the answer that what is happening to gold goes well beyond economics and finance, goes well beyond the fluctuations in geopolitics. There's something secular going on, and that has two elements. One is slow diversification away from the dollar in the reserves of central banks around the world. And the other one is a slow diversification away from the dollar payment system. Now, the good news for the US is both are slow because you cannot replace something with nothing. People are still building alternatives. The bad news is that the momentum is building up. So this is something that people have to take seriously in the US if they want to maintain the influence that the US has globally.
Mohamed, do you think this is a fairly recent trend or something that's been building for a number of years, maybe even decades?
It's multi-year, but it's been accelerated recently by two events. So it's multi-year because there has been some questioning about the U.S. being a good steward of the global system. The global financial crisis was the first shock. The weaponization of trade and investment was a second shock. The way the U.S. treated inflation was a third shock. So there's been questions built. And we've seen little pipes being institutions, payments system. But then there's been two more frequent, more recent events that have accelerated that. One is Russia being able to continue to trade and grow while being kicked out of SWIFT. That has gotten a lot of people paying attention. How did Russia do this? And of course, the answer is they built a very clunky system that involves 4 other countries, but it works. And they avoid the dollar completely. That's first of all. Second development is what's been happening in the Middle East, where the majority of countries around the world have viewed the U.S. as an inconsistent backer of human rights and an inconsistent backer of international law. So you've had those two recent developments that have accelerated something that's been in play for a while.
Mohamed, I'm glad you mentioned what's going on with Russia. John and I spoke to Dalip Singh yesterday, Biden's Deputy National Security Advisor for International Economics, and we asked him this. What do you say to those that say sanctions don't work? They just create new markets. And his response is, well, what's your alternative? You have to do something. I guess the question is, what is the alternative?
So that's a really hard question, Anne-Marie. There is no easy alternative. I think if you look back, those who imposed those sanctions now wish they had gone far further straight away. That this slow augmentation of sanction has given Russia enormous time to build alternative systems. That if you're serious about sanctions, then you should be willing to absorb the cost of sanctions to you. And that's something that neither Europe nor the US was willing to do initially. They were very worried about the blowback in terms of oil prices in particular. But looking back now, I suspect that they wish that they had gone further initially.
Well, that's part of the problem when a lot of critics of this White House is why have a price cap, just sanction the actual oil and gas and cut off the funds that Putin is using to continue to wage this war. Putin is hosting the BRICS summit. He says it's now a multipolar world is emerging. Do you agree?
So certainly the BRICS summit is involving more countries and more heads of state. But to jump from there to say multipolar world, that's way too far. It is still at a very, very early stage. It's going to be very hard to get them to unite around certain issues. So we should pay attention. I think if you want to worry about a multipolar world, you worry about China. China is creating institutions. The U.S. is not part of the Asian Infrastructure Investment Bank, and that institution is growing and is collaborating with the World Bank. China is building little pipes around the system, 50 bilateral payments agreement with other countries that completely exclude the dollar. So if you're looking at the alternative architecture, pay attention to China. Now, I want to stress there is no other currency to replace the dollar at the core of the system. And there's no other payment system to replace the dollar payment system, but you can build pipes around it, and that's what starts fragmenting the system.
And as we know, China has been buying a lot of gold. So, Mohamed, let's bring it home a little bit. We've talked a lot about international forces. Let's talk about domestic ones. The US deficit. Now, if you look at traditional financial indicators like the Treasury market and foreign exchange, Treasuries, we're seeing higher yields, but what we're not seeing in the FX market is a weaker dollar. We're not seeing a weaker dollar, and some people might suggest that that's not a real worry about the deficit then, no real sign of a buyer's strike away from dollar-denominated assets. You're not seeing the euro, the yen, or the Chinese yuan much stronger off the back of this. Now, some people might push back and go back to your story, Mohamed, and say, actually, you are seeing the dollar depreciate. You're seeing it depreciate against gold. Mohamed, can you share your thoughts with us about whether we are starting to see some concerns creep in about the US deficit into financial markets?
So first, let's start with currencies. Currencies are relative prices. So you would not pick up concern about the U.S. deficit because other countries have their own debt and deficit problems. You know, I go back to this notion, the U.S. is the cleanest dirty shirt. So you will not pick up in the currency, in the relative price. So you have to look at an absolute price. And that's why people compare the dollar to gold. Gold is a store of value. Gold is not really a currency or a unit of account. It is a store of value. And people look at that and say, well, relative to gold, the dollar is depreciating. Now, why is it doing this? I talk a little bit about that, but it's not just the impact of the debt. I mean, the impact of the debt is making people wonder about how, over the very long term, I want to stress, the creditworthiness of the U.S. Bond yield levels are now being impacted, John, by four things, and you pick. No one has been able to tell what it is. One is U.S. economic exceptionalism. We are simply growing better. Look at the recent IMF revisions. U.S. up in terms of growth rate. Second thing is the recalibration, although I hate that word, the recalibration of expectations for the Fed. And a question mark as to was 50 basis points in October a mistake. The third issue is the debt. And the fourth issue has to do with the overall sort of confidence in there. No one's been able to tell me, John, with any degree of confidence, the relative weight of the four. So yes, that may be an issue, but I'm not sure how big it is.
Mohamed, you forgot one provision, one topic, the U.S. presidential election. Is that impacting gold right now? Is that impacting bond yields right now?
So certain people feel it's impacting bond yields, and they throw it in there. And then you ask, how is it impacting bond yields exactly? Is it the tariffs? Is it industrial policy? What exactly is playing out in there? And then it's hard to answer. So I'll add it, if you want, to the list. But I suspect that the coefficient on that is not as high as the coefficient on some other things, particularly U.S. economic exceptionalism and Fed policy.
Mohamed, just a final word, Yankees or Dodgers? That's all we want to know.
Anne-Marie's sitting right next to you, and she has a wonderful New York Yankees cup on there. I told her in an earlier thing that for the first time ever, I may be thinking of abandoning the National League.
Mohamed El-Erian, big call there. Mohamed of Queen's College, Cambridge. That was the bigger call. Never mind the gold price.
I'm just curious if he's paying up for those tickets.
This was like you and the shopping channel there.
Yeah.
Look, it's QVC. It's perfect. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Morgan Stanley has named CEO Ted Pick as its next chairman of the board. Pick was expected to be named for the role after his predecessor, James Gorman, stepped down, or announced that he would step down, rather, at the end of the year. Pick took over as CEO at the start of this year. Under Pick, shares have climbed nearly 28%. Donald Trump is expected to appear on Joe Rogan's podcast later today. Political reporting that the interview will be held at Rogan's Austin, Texas studio. Rogan's podcast is the nation's most popular. It has over 14 million followers on Spotify. Trump has never appeared on the show. Meanwhile, Rogan's commentary on the former president has ranged from critical to friendly over the last few years. A spokesperson for the Harris campaign confirmed that the vice president will not be appearing on the Rogan podcast. 4 astronauts returned to Earth this morning after a nearly 8-month stay at the International Space Station. Their stay was extended by Boeing's capsule trouble and Hurricane Milton. A SpaceX capsule carried the crew parachuting before dawn into the Gulf of Mexico just off the Florida coast. 2 Boeing Starliner test pilots, though, are still stuck in space, where their 8-day trip was extended to 8 months. They are set to return in February. That's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, Wall Street facing down U.S. election risk.
When you add on regulatory potential arbitrage, and that may or may not be a consequence of protectionism or is another form of protectionism, then you easily go into the debate of how to protect your financial markets.
The latest from Citi. Up next on the program, live from New York City this morning. Good morning. Equity futures on the S&P 500 up here by 0.2%. Bond yields a little bit lower, down 2 basis points, 419.40. Even with crude a bit higher, up by 0.8%, $70.75. Under surveillance this morning, Wall Street facing down election risk.
You look at how capital can move across different jurisdictions in a way that can create value and can help address many of the topics that are affecting our economies and our societies, then you start to see really the cost. When you add on regulatory potential arbitrage, and that may or may not be a consequence of protectionism or is another form of protectionism, then you easily go into the debate of how to protect your financial markets.
So here's the latest. Bank stocks hitting levels not seen since 2023 after a better-than-expected earnings season, the US election and an overhaul in bank regulations still causing some uncertainty for traders. But Citigroup chair John Dugan saying he doesn't expect the revamped bank capital rules to be finalised until after the inauguration of the next president. Lisa joins us now from Washington with a special guest. Hey, Lisa.
Hey, John. Yes, indeed. It is John Dugan in the flesh. He is the chair of Citigroup, has joined the board since 2018, and has really seen a whole host of cycles after formerly being the OCC chief during the financial crisis. John, thank you so much for being with us. I want to start with this idea that there just are so many unknowns, whether it's regulation, whether it's trade policy, whether it's tariffs. How much are people in the banking industry somewhat paralyzed?
I don't think so. I'll give you a good example. Our trading business, this can be a very good time of the year because there's volatility there's uncertainty. And when there's volatility, that's good for our markets business. On the other hand, there are other businesses, if you're an investment banker, these 2 weeks leading up to the election are not likely to be active in the deal space. But this too shall pass, and people are navigating it and just looking ahead to see how they will navigate it.
One of the levels of uncertainty is just how bifurcated are the scenarios depending on whether Kamala Harris wins or whether Donald Trump wins. And if you could just bring us into a window of Citigroup's thinking of what the parameters are. You know, what's the sort of base case in the extreme case if Kamala Harris gets into office, and what about with Donald Trump?
So I think if Kamala Harris gets into office, we can expect more of a continuation of the policies that we've seen under Joe Biden, although it could be that it would be a little bit more business friendly because we may have a Republican Senate, and that's the conventional wisdom now, and that means nominations in order to get through the Senate are going to have to be a little bit more negotiation with the Republicans, and that could change the makeup of the people who get through. So that's a more modest change, I think. On the other hand, if Donald Trump wins the election, there will be very significant changes to personnel, and that could change the whole nature of who our regulators are and how we operate. And that's an unknown, but it will be very different. It's a little difficult to plan for because we don't know exactly what that would mean.
Typically, less regulation, a lot of people think of as a positive for banks, that allows them to be more profitable. Citi is in a unique position because you are a global bank that really does benefit from trade and from the free flow of cash between different economies. How would Citigroup really rearrange if free trade is impeded, if you do get a real restructuring with tariffs and other protectionist measures?
Yeah, I think the way we look at it is, yes, it is true that globalization has benefited Citi because we're in 100 countries on the ground and do business in another 50. But the fact of the matter is, if people change from being in a lot of countries to being somewhat fewer countries and changing and figuring out how to change those supply chains, we are in a very good position to assist people as they make those changes, because we have people on the ground in the places they're going to and the places they're coming from. And so we see that as business opportunities. That's the kind of thing we navigate all the time.
How much do you see Donald Trump really differing in terms of regulation when it comes to antitrust and some of the banking capital oversights, especially given some of the commentary that we've heard from his vice presidential running mate with respect to the current FTC leadership? And I ask this because I have to be honest, I was with a banker when that news dropped about Capri and Tapestry, and he was just beside himself. He couldn't believe that this was sort of the framework with affordable luxury handbags. I'm just wondering if that is sort of the expected norm going forward for you.
I think the way I would put it, I think there's an expectation that there will be more transactions and more deals that will get done, and that's a positive thing for our deal business. And so we would look forward to that. If it doesn't happen that way, we will not navigate the other side.
So 10 days ago, Citigroup came out with earnings, and it showed that it was seeing strength in a lot of the different 5 business lines as it streamlined things. It was a beat across the board, really good. Shares popped, and then Jane Fraser got on the phone and with analysts, and someone asked her about a possible asset cap, about whether potentially there could be some implementation. And she hesitated, and the shares plunged. And then she clarified, no, there is no asset cap, and there is not any plans for any kind of asset cap. And yet the shares still fell on that day. How frustrating was that for you?
Very frustrating, because she did clarify it within minutes of the uncertainty around it. And what she said is absolutely clear. There is no asset cap. We don't have an expectation for an asset cap. And our business performance was really very strong in the third quarter. So it's a bit of a mystery, and yes, it was frustrating.
How does Citigroup get out from under this regulatory cloud that seems to be sort of increasing a lot of skepticism in investors?
We have to make progress slowly and surely every quarter in making proof points of doing what we say we're going to do business-wise. So, for example, in the third quarter, as we had committed to, our revenues were up 3% on an ex-divestiture basis. Our expenses were down 2%, operating leverage increasing in each of those 5 business lines. Those are the kinds of things that we got to keep doing to show that we're making progress towards our medium-term targets of an 11 to 12% return on tangible common equity.
Where is Citigroup in this transition to streamlining these 5 businesses right now?
I think we're in a very good, very exciting place. I think the board is quite excited about how the company is doing as measured by those 5 businesses, which, by the way, is much more transparent now. You can see it much more. There's there's a removal of a layer between the board and Jane and those businesses. They're much more accountable because it's so transparent about how they're doing. And we saw some very exciting things in the third quarter. I'll mention 3 of them. The Apollo credit deal, $25 billion deal, very innovative. We had the largest deal transaction with the Mars acquisition of Kellanova that was announced, where we were the sole advisor. And we had a very exciting deal with MasterCard to tap into their international debit network. And these are the kinds of things where Citi really is getting on its front foot in each of these businesses.
How much are you thinking about another deal like the Apollo one?
It's early days on Apollo. I think, as I said, we're quite excited. We think that really gives us the ability to offer a whole range of things to clients that we wouldn't otherwise be able to do, and that's the important piece. Let us see how it goes before we go down another path.
As a global bank, are you still sort of emphasizing that global reach at a time where everyone's looking at the U.S. and saying, it looks pretty good over there?
Still a lot of business going on all over the world. We're there to help people in their be the preeminent bank for companies with cross-border needs. They may have different cross-borders that they're using and cross-border needs, but we're there to help them for exactly that.
John Dugan, wonderful to see you. Thank you so much for being with us.
Thank
that was John Dugan, the chair of Citigroup's board. And John, I'm going to send it back to you.
Lisa, wonderful conversation, as always. More from Lisa a little bit later this hour. Jason Thomas, the head of global research and investment strategy at Carlyle, joining Lisa later this hour in about 20 minutes' time. I want to check out shares of Apple just quickly. In the pre-market, down by 0.9%. Some real anxiety going into earnings in the next week. This coming from KeyBank this morning. Consensus expects an unrealistic inflection across Apple's business, while its valuation appears expensive. They downgrade the stock over at KeyBank.
Meanwhile, Tim Cook is there. He's sitting down in a meeting right now with China's commerce minister. We have seen him also take to WeChat and other social media platforms in China, filming selfies, talking to local Chinese social media stars. A massive push into this market because they have to be. But what's China doing? They are losing market share almost every day, it feels like, every quarter, to national champions like Huawei in China.
More on that stock in just a moment. For the broader market, equity futures up by 0.2% on the S&P. Up next on the programme, Neil Dutta of Renmac with US payrolls due a week from today. The payrolls report, 1 week away, the estimate in our survey, 120K. Your equity market on the S&P 500 with a little bit of a lift this morning across the board on the S&P 500. Positive from New York. This is Bloomberg. Apple down this morning, 0.9%. KeyBank cutting the stock to underweight from sector weight. Here's the quote from them. Apple is an impressive business with what we believe are unrealistic expectations to re-accelerate growth across all product categories and geographies. We're down 0.9%. The earnings a week away. Equity futures more broadly on the S&P on the Nasdaq doing okay. Equity futures up by 0.2% on the S&P, likewise on the Nasdaq, up almost a third on a Russell. In a bond market, a 2-year, 10-year, 30-year shaping up as follows. Waiting for that payrolls report to drop in a week's time. 419.40, yields are lower by 2 basis points. We're down 2 on a 2-year to 4.05%. And in the bond market, it is all about payrolls next week.
That's what Mohamed El-Erian is talking about. He's looking at more of the economic indicators when it comes to the bond market, not this idea that potentially this is a Trump trade that's being put on. But how difficult is this payrolls report going to be? Everyone we speak to on this program has said, look through the bad data, the hurricanes, Boeing. Our Bloomberg Economics is talking about a negative print. What does the Fed do with that?
70K is the low in our survey. Stephanie Roth's going to join us a little bit later from Wolfe Research. Joining the programme in about an hour from now. The high is the 160-something. We were talking about taking off, I think, 100K. Governor Waller talked about 100K off the number, off the back of the strikes and the hurricanes. And here we are a few weeks later. Claims are back to pre-hurricane levels. I've got no idea how much we should take off next week.
But is it just 100 because of the impact of weather and strikes? Or do you have to add another 60 because of how the Department of Labor collects their data? And already we know the revisions usually are to the downside.
Neil Dutta's going to have his own thoughts on this. Neil Dutta's about 5 minutes away. Under surveillance this morning, the US exploring different options to restart stalled talks between Israel and Hamas. Secretary of State Antony Blinken saying negotiators are set to meet in the coming days.
So look, we've been here how many times? Deals potentially on the table. You don't see the movement from the Israelis, and really you don't see the movement from Hamas, who continues to dig their heels in and don't agree to anything. Of course, the United States is going to push for this. And part of this is not just the fact that Secretary Blinken is in the region, the 11th time since that October 7 terrorist attack, but they have to keep the dialogue going, especially now, because we are less than 2 weeks out from a U.S. presidential election.
So if you're Israel, what do you do? 2 weeks out, it might be Donald Trump back in the White House. Are you going to wait? Going to wait to make big decisions?
I think for Israel, just, you said you're chief of Mossad, as you said you would, to Qatar, and you have these negotiations, but potentially you don't do anything massive before the election. And I'm still waiting on whether or not we're going to see that retaliatory strike. There was a leak from the United States, and potentially Israel's waiting for a lot of things to cool down, the secretary to leave the Gulf, but maybe even waiting for the U.S. presidential election. Get that over with, and then look at potentially all their options.
Going into another weekend, waiting for the same thing. Brent crude up by 0.8%, just short of 75. WTI this morning, $70.81, up by 0.9%. Let's get into the election and the campaigning. Donald Trump and Kamala Harris entering hostile territory this weekend. Trump holding a Saturday rally at Madison Square Garden here in New York City, as Harris is set to hold several events in Texas, including a rally with Beyonce.
So this is interesting, because I think Evan Roth-Smith nailed it this week on our program, saying this isn't about trying to win votes for the top of the ticket in New York if you're Donald Trump or in Texas if you're Kamala Harris. It's shock and awe. How do you win that news cycle? You win that news cycle by showing up and, quote unquote, playing the garden, which is what people close to the former president tell me. Reagan won re-election in a landslide in 1984. That was the last time a Republican carried New York. That's not going to happen. Kamala Harris is not going to win Texas. But this is a moment for her, one, to highlight reproductive rights in a place where there's stringent controls on women and abortion access, and also hometown of Beyonce. That could potentially win a news cycle. That's what they're trying to do.
Win the news cycle, but convert how many voters? How many Beyonce fans haven't decided who they're voting for?
I don't have data on that, but I'm sure it's not a lot.
How much was it actually going to change? How much does this change?
I think for Taylor Swift, it was about registration. You did see an uptick of individuals who clicked on her link that she shared, so you're able to track what that registration was looking at. Do they go out and vote? We don't know. Beyonce has done this, though. She performed, I think, 3 days before the presidential election in 2016 with Hillary Clinton.
Yeah.
It didn't work.
Purely from the perspective of entertainment, looking forward to Trump and Rogan.
So am I. Do you know why?
Today?
Because they have beef. Rogan at one point was a Bernie Sanders supporter. He also said, I'm not giving Trump airtime and access to my 15 million individuals because I don't support him. He also has been quite kind to Kamala Harris. That campaign was even considering going into the lion's den of Joe Rogan. They're not going to be doing that. She's sitting down with Brene Brown. going after women.
That's a little bit different to the conversation we could see on Rogan. Let's talk about what's happening in the restaurant business. More fast food chains pulling onions on E. coli fears. Locations under Yum brands, including Taco Bell, Pizza Hut, KFC, all removing onions tied to Taylor Farms out of the abundance of caution. McDonald's is working with health authorities to confirm the source of a contamination affecting 13,000 stores.
So you have to think the Taco Bells, the KFCs, of course they're going to do this. You have to be prudent. And why? Because historically, we know what happens to companies, we know what happens to their trust in consumers, and we know what happens to their share price when they're not. You go back to what happened with Chipotle, double-digit losses when they couldn't really contain that E. coli outbreak.
We've seen what's happened with McDonald's this week. The stock is lower so far this week by almost 5%. Looking ahead to next week, the October payrolls report 1 week from today. The median estimate in our survey expecting 120,000 jobs added after last month's blowout print of 254,000. Joining us now is Neil Dutta of Renmark. Neil, welcome to the programme, buddy. We've got a ton of issues to work through. Let's just start with payrolls. Claims yesterday back to pre-hurricane levels. Walk me through how you're thinking, the process you're going through to come up with a number for this month that gets released next Friday.
Well, I think it's the way most of the street is. Going like that. No. Look, I think when I look at the jobless claims data, I think it's good that initial claims appear to be stabilizing at something close to where they were before the hurricane. But continuing claims have generally been going up still. And, obviously they're lagged a bit. But, for the survey week, we know that continuing claims hit a cycle high. And so what that probably means is that, some increase in unemployment is probably inevitable with the next cut of the jobs number. In terms of how many people are affected by the hurricane, I mean, that's a little bit more difficult to game out. But certainly, I'm going to be keeping an eye on manufacturing employment because of what that, has to do with Boeing and the potential downstream effects of the strike across that company.
I know even if you take these issues away, you don't like the setup through Q4 into year end and into 2025. Neil, let's get deeper into that. What are the issues that you see that you think that maybe some people are ignoring at the moment?
Well, sure. I mean, keep in mind that aircraft equipment investment was a huge driver for GDP growth over the last couple of quarters. That's probably not going to be with us in Q4. At the same time, we know that business and investment intentions more broadly have been quite sluggish. So, I don't think equipment spending is going to be the driver of growth in Q4 that it's been. Remember, that's contributing about 0.5 percentage point to growth in the third quarter. And, the housing market, whatever neutral is, it's got to be a lot lower for housing because residential investments going to continue contracting into Q4. You look at the recent backup in mortgage rates, that's going to weigh on transactions. But more broadly, if you look at sort of new single family homes that are for sale that have been completed, I mean, that's up 40-50% against last year. So I think inevitably you're going to see some weakness in single family residential real estate construction. And we also know that multifamily construction is likely to keep coming down because starts are running well below completions in that sector. So I think residential construction activity is likely to be weak. And, in my mind, the labor markets are still broadly cooling. I do think that one interesting kind of wrinkle with the next cut of the jobs number isn't so much where October comes out, but what the revisions will look like for September. Because remember, the initial response rate on the September number was quite low for September. So that doesn't tell us about which way the directions are, the revisions will be, but it does tell us that there will be revisions. So I think that's going to be pretty interesting. But at any rate, I mean, nominal income growth over the last 6 months, when you look at jobs, hours, and earnings, I mean, that's running about 4%, which is a lot weaker than the kind of growth in consumer spending that we've seen in the third quarter. So my sense is that you get a little bit of slowing in consumer spending as well. And obviously, there's a lot of kind of, I think there's a bit of front running of the election. So if you end up getting what the markets are pricing, maybe there's not as much of a tailwind when it does happen.
Neil, we'll get to the election in just a moment. I just want your thoughts on the Federal Reserve. The Fed has basically communicated a bias to reduce interest rates. From what I understand from you, you believe they're needed. Do you see them wavering whatsoever based on what we've seen on payrolls, 254 for September, what we saw on retail sales just a week or so ago?
Well, certainly some are wavering, but I think that was kind of known because 7 of the 19 officials in September were already kind of on board with skipping a meeting before year end, right? They only had 75 basis points worth of rate cuts baked into the outlook for the end of the year. I think the Fed will go in November. The markets appear to be flirting with the notion of a skip in December. And frankly, I think by the time we get to December, skipping the meeting will be unlikely because of the things I'm talking about.
Neil, is there a print that we could get that would put the Fed saying we're going to wait and skip November?
I mean, if you get another number like you did, last month, this month, I mean, even with all these hurricane effects, I mean, if you get that kind of run rate on a 3-month basis, I think that would probably change the Fed's thinking on the state of the labor market. But generally speaking, when you look at the totality of the data, I see labor demand continuing to cool. You look at job postings data, the Indeed folks have it on a weekly basis. That's been slowing. If you look at hiring rates, they haven't really gotten off the ground. Quits rates remain low. We just had the Beige Book, which is always released ahead of the Fed meetings. And, if you look at that, it looks like most of the country is actually flat to down. Only 2 districts are up. So there is a bit of a disconnect, I think, with some of with a lot of the data points that have been coming out. But generally speaking, my own view is that the labor market trend is probably a lot closer to where things were at the end of August than where they were at September.
Neil, let's get into the election, the politics, the policy and financial markets. And let's maybe go back to 2016. We all remember the run up to November 2016. Every single note, every single headline, particularly in the media, that the former president, Donald Trump, at the time, candidate Trump, would be bad for equity markets. And then we decided at about 4 a.m. that night, overnight, that he was going to be very good for equity markets. The story now, as you've identified, is that the former president is bad for the bond market. Can you tell me how you're thinking about the balance of risks around fixed income, given where people are positioning and how they're thinking about the outcomes of the election?
Well, certainly in every client meeting that I go to, no one I talk to really wants to be long duration going into the election because of what you're talking about, that the prospect of a potential unified government coming out of the election. But, so that to me suggests that a lot of this might already be priced in. If you look at sort of prediction markets, polling, I mean, I do think that this is not like 2016 when Trump was basically a 1 in 5 shot. The odds are a lot higher now. So I do think a lot of this might be priced in. But it's also important to keep in mind that, if you do get some kind of a sweep, where the House majority, if it does go to the Republicans, will be probably quite thin. Right. I mean, it's already quite thin. So it's not like there won't have to be a lot of wheeling and dealing that needs to be done to get things, over the finish line next year. I think it's going to be still like, even if it's a unified Republican government, that doesn't mean that the Trump team's just going to be able to steamroll whatever it is they want through Congress.
That's true for taxes. It's not true for tariffs, Neil. So what could that implication be?
Well, again, I mean, if you get what is being proposed, that would obviously be bad. But it's also, that was also true when we were talking about these things in late 2016, early 2017. But remember, the fact is that the tax cut law actually sunsets at the end of next year. So that should focus the mind. I mean, remember, it's about the sequence of events. It's about the sequence of events. I don't necessarily believe that tariffs will be the first thing out the gate. It'll probably be focusing on the tax law. So if you remember the kind of sequence, the first time, and again, this is still a toss-up race, but if it was Trump, in 2017, he was the market's best friend because all the sort of things that were going on in D.C. was about sort of growth-friendly initiatives, deregulation, getting the Tax Cut and Jobs Act passed. And the fact that the law sunsets at the end of next year may focus the mind, particularly because you need Congress to get that done. So, and then when they're all campaigning, in the year after, in 2026, maybe that's when the tariff discussion comes to the fore. So I think it's about the sequencing. I don't think that, this is the sort of, vote harvesting season. Everyone wants to sound tough. That doesn't mean that, I think it's important to take, some of these things that are being proposed here with a little bit of a grain of salt.
I know.
Not take it completely literally.
Always great to catch up with you, sir. We take you literally. Neil Dutta of Raymond. Thank you, sir. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Tesla CEO Elon Musk and Russian President Vladimir Putin talk regularly. The Wall Street Journal reporting that the two have been holding conversations since 2022. The paper cited U.S., European, and Russian officials saying that the two talk about personal topics, business, and geopolitical issues. The owners of the cargo ship that caused the collapse of Baltimore's Francis Key Scott Bridge have agreed to settle a civil lawsuit from the United States. Two Singapore companies have agreed to pay $102 million, which will go towards the cost of cleaning up the wreckage. In the lawsuit, the U.S. said the companies used an ill-prepared crew and, quote, cut corners in ways that risked lives and infrastructure. The New York Liberty were greeted by thousands of faithful fans as they celebrated their championship with a ticker tape parade through the city. As many as 80,000 fans came out to celebrate the Liberty's first ever WNBA title. The event culminated with a ceremony on the steps of New York City Hall. It was a welcome sight for the city, with the last sports-related parade happening over 5 years ago after the U.S. women's soccer team won the World Cup. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Up next on the programme, a growing debt pile, all but guaranteed.
The next president, whoever that may be, and next government will have to deal with fiscal sustainability. And interest rates will matter for the government, not just for the economy.
That conversation up next. Equity futures on the S&P up by 0.25%. In the bond market, yields a little bit lower, down 3 basis points, 418.21. Under surveillance this morning, a growing debt pile, all but guaranteed.
Either way, you're going to see a rise in overall debt outstanding. And this is where it starts to really matter. I think the next president, whoever that may be, and next government will have to deal with fiscal sustainability. And interest rates will matter for the government, not just for the economy. And so as we get towards 5% or higher, it's going to really start to challenge the ability to spend like we have been.
So here's the latest. Trump and Harris both outlining plans projected to increase the national debt. Jason Thomas of Carlyle saying fiscal issues will persist irrespective of who wins the election. History suggests that governments only engage in deficit reduction on the required scale, here when it's perceived as necessary to reduce borrowing costs. Jason joins Lisa in Washington. Hey, Lisa.
Hey, how's it going, John? Jason is here, and I do want to start there. This idea of typically when people worry about the deficit, it starts to get priced in. It is not, unless you think that what we're seeing right now with yields rising really has to do with that. Is that the case? Do you think that long-end yields rising has to do with the deficit, or does it have to do with other factors?
Well, I think that it is, of course, the deficit is contributing to nominal GDP growth. It's contributing to inflation remaining closer to 3% than it is to 2%. So I don't think we just need to look at a risk premia in the market or in terms of the backup in long-term yields. We just need to appreciate the deficit today, 6.5% of GDP, but at full employment. So this is quite different than the deficits from a decade ago. Also similar proportion relative to the economy, 6.5%, but coming at a time when unemployment was 8%, when tax receipts were depressed, when social services spending was relatively high. So what's different here is that when you adjust for the state of the economy, the Treasury is injecting about $1.5 trillion of incremental liquidity into the economy. And that, I think, is something that people have to take into account when bond yields and, again, inflation, nominal GDP growth.
So we were talking before the break, and there is this question of whether we're actually just seeing people figure out that the neutral rate might be a lot higher. Right now we're pricing in about a 3.4% rate at the end of next year for the Fed funds. But right now it seems like maybe you think that the market is just adjusting higher and is going to kick that back up to something closer to 4. Is that right?
I think that's reasonable expectation. The way that I've related the current experience is similar to the taper tantrum.
The reason I say that is because in 2012, everyone was convinced that bond yields were unnaturally low. The expectation was that as soon as the Fed stops purchasing assets, bond yields are going to spike and they're going to normalize. What happened, of course, when Bernanke in 2013 shocked markets, the Fed followed through, stopped buying bonds. By the end of 2014, within 18 months, bond yields were about the exact same level as when Bernanke first surprised markets with the suggestion. So then from that point on, people started talking about R star. They started talking about the fundamental determinants of real interest rates. And people recognized that monetary policy could not be the entirety of the explanation for why rates were so low. Today, I think that there was this expectation. We had this temporary spike in rates because the Fed was focused on maintaining credibility, getting inflation down, and that we would then go back to 2.5% thereafter. And now they're realizing that there are really seismic structural changes in the economy, the shock from AI, the industrial policy and the capital needs there, changing attitudes towards trade. And as when you accumulate these factors and you take stock of them, you end up with a inflation stabilizing interest rate that's probably closer to 4%. And I think this is just the market digesting that.
Do you think it's a mistake at this point for the Fed to cut further?
No, I think that as inflation goes down towards 2%, you would not suggest that this economy requires a real interest rate of 3% or close to 3%. So I think there's at least 2 more cuts that are coming, maybe a third, we'll see. But when the Fed first cut rates in September, the market had priced 10 cuts over the next 12 months. So I think it's just dialing back those expectations. But rates are still coming down. I think that's virtually assured.
Just really quickly here, even if the Fed doesn't cut, do you think that risk assets are in still a sweet spot, particularly in the private credit sphere?
Well, I think that what is underappreciated about this economy is that a relatively small share of GDP, relatively small share of the economy, is making such an outsized contribution to growth. According to our data, really it's about 4% of GDP, adding almost a full point to growth. That's of course data centers. It is that's the infrastructure, and in addition to the hardware applications, it's renewable energy generation facilities, green industry, things like EVs, battery, semiconductor fabrication plants. And so I think that this economy is actually performing better than expectations, certainly better than people expected 2 months ago as they really started to worry about a couple of soft months of data. And as a result, I think that there's reason to suspect that there's a lot more runway for growth than people had been anticipating.
So yes, it seems like a good time.
No, I think you have to worry about valuations. You have to worry about are credit spreads too tight. I mean, so there's there's a lot of complications, but I think the underlying the tailwinds are sufficient.
Jason Thomas, thank you so much for being with us. John, I'm going to send it back to you.
Hey, Lisa, thank you. Great work as always. Coming up in the next hour on Bloomberg Surveillance, we'll catch up with Tom Kennedy of JP Morgan. Bloomberg's Ed Ludlow looking ahead to a massive week for tech earnings. Stephanie Roth of Wolfe Research looking for 70K on the payrolls report next Friday. And we'll speak to Sonia Meskin of UBS from New York City this morning. Good morning. The third hour of Bloomberg Surveillance up next.
There is a sense, I think, that the markets are increasingly worried about some kind of fiscal risk.
Companies are just a little less optimistic than they were a few quarters ago.
The issue of the year has really been whether we would broaden out, and I would say that is happening.
When you look at equities, we're going to get growth, right? So, forward returns are just going to be much more muted.
Corporate America is sitting there saying, I'm in a pretty good position. The economy's doing well.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
We've got such a big week coming up for you. Earnings from Alphabet, Microsoft, Meta, Amazon, Apple, all coming up next week. The climax of next week, payrolls. Payrolls Friday just around the corner. Equity futures on the S&P 500 into all of that. Firmer by 0.25% on the Nasdaq 100, up by a third. In the bond market, yields have been climbing all week by double-digit basis points on a 2-year and a 10-year. We retreat. We're down 2 basis points, 4.19 on 10s on 2s, 4.05%. As for the guesses for next Friday, 120. The median estimate in our survey, this just drops from Citi. We expect a soft 90K new jobs and a 4.2% unemployment rate next week.
And Andrew Hollenhorst goes on to say it may take until December for the market to turn attention back towards recession risk. Why? Because we had that blowout jobs report. You've said it all morning, Jonathan. The upside surprise potentially we could see in next week in that jobs report following that jobless claims. How much is the hurricane going to be priced in? And if it's not, what does that mean for the Fed?
2 weeks ago, the only thing we talked about was messy data. Messy data off the back of 2 hurricanes and a strike over a Boeing. And here we are with jobless claims back to pre-hurricane levels and people scratching their heads. What kind of number do you put in for a guess for next Friday?
I don't know, because Bloomberg Economics is talking about a negative print. And then if you take off, say, what Waller said, Governor Waller, take off 100,000 because of this messy data, the hurricanes, the strikes, but then you also have to take off another 60 or 70 just because of basic revisions that you have to slap off any job report that comes out. It's very difficult. And then it's noisy. Because what do you hear from businesses? What do you see in the beige book? The presidential election has businesses on the sideline, potentially not wanting to hire or fire until they get a little bit more clarity on what policy looks like 2025 and going forward.
The former president sat down with Bloomberg a few weeks back, and he told John Micklethwaite that perhaps Chairman Powell had the easiest job in Washington, D.C., and perhaps you agree with him. But let me tell you, in a few weeks' time, that is not going to be an easy decision to make. They'll have a distorted payrolls report, possibly, an election without an outcome, potentially, and on November 7th, they've got to make a decision. Now, they've got a bias to cut interest rates. They've communicated that quite clearly. What we're asking is what would upset that bias to reduce interest rates? How big would that number need to be next Friday?
I think we're hearing from a lot of analysts, anything north of 150 to the 200,000 a print range potentially gets the Fed a little bit more nervous, looking back at the labor market in terms of, do we see this weakness? But more people are actually thinking maybe it's December that they'll have to miss because it's pretty much November's baked in. Or maybe, because it's the blackout period, they start calling up some of their friends in the media.
Counting you down to a big few weeks ahead, and let's hope we don't have to do all that all over again. Equity futures on the S&P 500 firmer here by about 1/3 on the S&P, up around, or rather down around a basis point or two on a 10-year to 419.60. Coming up this hour, we'll catch up with Tom Kennedy of JP Morgan as the S&P 500 heads for its first weekly drop in 7. Bloomberg's Ed Ludlow previewing next week's big tech earnings, and Stephanie Roth of Wolfe Research on why no landing fears haven't run their course just yet. We begin this hour with equities inching higher as investors digest upbeat earnings and strong economic data. Tom Kennedy of JP Morgan eyeing the upcoming election and saying the following: elections can stoke volatility, but interestingly, equity volatility has been relatively low for an election year. In the long run, elections don't drive financial assets, but you'd be forgiven if you thought this time is different. Tom joins us now for more. Tom, good morning.
Good morning.
Is it different this time?
I don't think it will be particularly different. The equity volatility point is very interesting to me in that we're talking about this being a very polarizing election, and socially that does feel that it might be that way. But in the market, realized and implied volatility all year has been very low. Implied volatility for October and November, historic averages, nothing real special about it. I think the market, as it always does, recognizes that earnings, growth trajectory, Fed trajectory are really what matter the most. And at the moment, we're sitting at a place where the soft landing has happened and the Fed is incentivized to keep it going.
That's an equity market observation. Can you say the same thing about fixed income, about treasuries?
No, you're totally correct, John. The equity volatility very low, fixed income volatility very high. As we're trying to sort out exactly where the Fed should cut to, just look, 2-year ahead expected Fed funds rates this year have moved between 275 at the low end and 4 and almost a half at the high end. This is unbelievable uncertainty about where things could go.
Path of least resistance, higher or lower yields. How are you thinking about that?
I think that's the place where things get interesting for the election. Is the election the Minsky moment for the deficit? Lots of very prominent commentators talking about that. And months ago, it could have been the budget deficit issues, the budgetary annual rounds there. I don't know if this one is. It's possible, but we don't even have really good analogies for where rates could go in that scenario. For the most part, people throw out 5% just because it's a round number and it's high from here. But we don't really have a great analogy. That aside, I do think rates to the low end for the next couple of years is the right thing, mostly because the Fed is biased to cut. And that should perpetuate unless you think the labor market will tighten magically, which doesn't seem the case.
If a Trump trade is, or a Republican sweep really, is being priced right now into bond market, what happens if we don't get that?
Yeah, you should see rates rally. Absolutely. At the moment, we have a Republican sweep scenario 10's around 4.25. And that's, for the most part, where we're at. So in the event we don't get that outcome, I think you should see rates rally, and you should see some of it a relief rally in equities.
When you're looking at volatility, what does the volatility look like after the election? Maricopa County officials are talking about maybe not having Maricopa County, which is the most populous county in Arizona. Maricopa County goes, the election goes for that state. Yep. If they don't have that result and there's a contested election, what does volatility look like in the financial markets?
Yeah, it's a good question. How long do we allow this uncertainty perpetuate itself? If it's a couple weeks, maybe volatility doesn't pick up materially, like where's the expectation? This goes on for a month, we should see volatility pick up. And the question becomes, when do central bankers need to step in if volatility is so big? I don't know the answers to those things. Those are the questions that I'm sure are being asked in Washington.
Do central banks and investors just load up on gold?
It's been the trade so far this year. The way, I think there's really four ways to think about the fiscal situation. Everyone's worrying about a meltdown. Well, we can pontificate about when the Minsky moment is, but what do you do about it? First and foremost, I think you see investors shorten up on their duration. That has been happening in our community, JP Morgan Wealth community, a little bit. Add more gold, that's been happening.
Yeah.
Think about international diversification, or more importantly, think about real assets. We put out our long-term capital market assumptions last week, and in there, expected returns on real assets are expected to outpace global equity markets for the next 10 years. So there's something to think about in there for global investors.
I don't think we have to benchmark necessarily to the extreme. It doesn't have to be a crisis or not. There could be something in between. Let's look at the policies on the table. It was interesting for me to hear you say that red sweep 420 kind of makes sense on a US 10-year. And then I'm thinking, well, OK, let's think about the proposals on the table. Yeah. Tax cuts, lots of them. Tariffs, lots of them. Deportations, lots of them. That should come potentially with initially hotter inflation and potentially stronger growth.
Yeah. I think there's two scenarios in the red sweep that we need to discuss. The first is this pro-cyclical, higher growth, higher inflation scenario, but the deficit's not a worry. 4.25 represents a world where the Fed is going to be exceptionally gradual in its rate cuts in response to that policy. But the red sweep where we wake up and it's the Minsky moment, that's where treasuries can really sell off and equities would sell off. That's the differentiator there. In our baseline scenario for a red sweep, I think it's a pro-cyclical environment where risk assets perform well, the broadening in the equity market continues, and rates are higher for longer.
So let's sit on the equity piece of it. You can see why this would be positive. There's a conversation about taking a corporate tax rate down to 15%. With conditions, I'm not sure what those conditions are. Do we know what those conditions are still?
Nope. Continuously ask. We don't know yet.
Still looking for some detail. So next week we get Alphabet, Microsoft, Meta, Amazon and Apple. This isn't going to be a tech story. That's not what I'm hearing here. Is this going to be a small caps, banks? What kind of trade are you putting on?
This is potentially an industrial revolution for America, where the artificial intelligence infrastructure, which is wildly insufficient for AI adoption, that could come very quickly. And that's a power discussion. That's a real estate discussion, data centers, of course. But it's intersecting the economy in a really interesting way, and an election that now is trying to separate from China, but China has vertically integrated itself into that supply chain of tomorrow. The example that I like the best is large cell lithium-ion batteries. 50% of them are imported from China to America. So, it's only 50%, no big deal. Well, when you look at the materials, the refinement of the critical minerals in a battery, it looks like just about every single large cell battery touches China at some point. So how do you separate when they've vertically integrated, and yet you need the power, you need the supply, you have a renewable transition? This CapEx looks wildly durable in the industrial space, and for investors in our community, it's try to diversify, get more confident about where the earning streams will be. Amazon, Meta, Google, Microsoft, your hyperscalers that you mentioned, John, really confident they're going to keep going there. They need that infrastructure for AI to be successful.
To that point, Torsten Slok this morning said we need to add 3 New York cities to the U.S. power grid by 2030 to basically make sure you can power everything you're talking about. But why is that a Trump trade? I feel like that's going to happen under whoever becomes U.S. president.
Completely agree. In the way that you think about investing, how can I have all the scenarios and win in all the scenarios? I think this is a trade that's going to work either way. And it's not a trade, and it's really an investment process, because this should go on for 1 to 3 years. And the real crux of the supply and demand imbalance is, when do we think most businesses use artificial intelligence? A couple years? Well, the Power Authority in Virginia, where most data centers are saying prices are going to go up a lot. And you're going to wait a long time to add a data center. So this supply and demand imbalance is real.
We've started to see the trade spread out, the second derivative into utilities. We've seen a massive year for utilities. What's lagged? What's the next step in this AI trade? What's next?
I still think utilities have our top sectors. Utilities.
Into next year.
Industrials. Tech is a part of that. And now how tech performs will inform how these other two, they're connected. These are not traditional cyclicals or defensives. They are part of this infrastructure ecosystem build out and tied to technology. We think those are the two best sectors to be holding into the election and into next year.
Do you think these tech firms need to demonstrate a more powerful use case for the end consumer, for the investors in them to carry on being patient, retain this tolerance for them to keep spending billions of dollars on chips out of NVIDIA?
So far, the spending on artificial intelligence out of these big names is mostly out of free cash flow. I think that buys them time to keep doing the CapEx because it's being financed and funded just from earnings. If earnings growth is going to slow next year, it is a dominant question in our community. How patient can we be with price to earning multiples this high? Diversify now. Most of our clients are still very overweight U.S. tech. It's been a great trade, amazing trade. But can you diversify and find better ways or less risk ways to get your portfolio where you want it to go? I think yes.
Tom, it's good to see you. As always, great to catch up. Tom Kennedy there of JP Morgan on the bond market, the election, and the pockets of the equity market that he likes right now. Equity futures on the S&P 500 up by 1/3%, with an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Shares of Capri Holdings plunging nearly 50% in the pre-market after a federal judge blocked the company's planned takeover of $8.5 billion takeover, that is, of Tapestry. The judge said allowing the owner of Coach and Kate Spade to buy the Versace and Michael Kors owner would harm competition, creating a company with a 59% share of the accessible luxury handbag market. Mercedes-Benz is planning further cost cuts as it faces weaker demand in China. The luxury car maker's profitability fell below its minimum target in the third quarter to its lowest since it split from the truck business in 2021. It's a sharp contrast to Tesla, who reported robust earnings tied to strong performance in China. And it is a good day to be Lionel Messi. The MLS Players Association released its salary update, revealing that Messi earns a $12 million annual base salary and a more than $20 million in total compensation. His salary is more than the entire payroll of 22 Major League Soccer teams. And that's your brief, John.
And he's still the only reason we're talking about the league. My opinion, I know, and I'm sure other people share it. Danny, thank you. More from Danny in about 30 minutes' time. Up next on a programme, The Morning Calls. Plus, Bloomberg's Ed Ludlow ahead of a massive week for tech results next week from New York City. This is Bloomberg. I knew, as soon as I said it, criticised MLS, I'd get pushback. Pushback from Cincinnati, where apparently the MLS is a big deal. I promise you I'll attend a game. Maybe not in Cincinnati, but I'll make it happen. Equity futures right now on the S&P up 1/3%. Bond yields lower by a single basis point, 419.60. The opening bell, 1 hour and about 13 minutes away. Let's get you some morning calls. First up, Citi, raising its price target on Tapestry to 55, saying the blocked acquisition of Capri simplifies the company's story. The stock is up by 15. The other name is down a heck of a lot. Next up, Raymond James downgrading T-Mobile to market perform. The analyst saying his thesis has played out. That stock is down 2%. And finally, the big one this morning, KeyBank downgrading Apple to underweight, citing unrealistic expectations and an expensive valuation. Sticking with big tech, a slew of companies set to report earnings next week, including 5 of the Mag 7. Alphabet kicking things off on Tuesday, followed by Microsoft and Meta on Wednesday, Amazon and Apple on Thursday. Bloomberg's Ed Ludlow joins us now for more. Ed, welcome to the show, sir. We've got some time to work through this. Let's start with yesterday before we get deep into next week. Oh, sure. Tesla, 22% move. Ed, just frame that move for us historically. That's a monster one.
Yeah, I think biggest move in almost a decade, right? And I think what's so interesting about the Tesla print and discussed it with a lot of investors is that we've discussed on this program about how Elon Musk's greatest skill is keeping investors looking to the horizon. So you kind of got that, a very bullish growth outlook for the core EV business, and then the kind of more sexy autonomous driving stuff further afield. But in the quarter gone, they demonstrated something which historically, to their credit, they've been very good at, which is being a profit machine, working out how to eke out more profit from the existing business lines. And that was notable. Although I think there's a little bit of skepticism about some of the deferred revenues around the software that they sell. But yeah, great quarter gone, bullish outlook looking forward.
And it wasn't just the percentage point move, it was the market cap move. $154 billion in a single day. And as our good friend Ollie Crook said earlier on this morning out of Europe, the combined market cap of VW, Stellantis and BMW doesn't even meet the one-day move we saw in market cap from Tesla just yesterday. What are they doing right compared to some of their European peers?
Yeah, I mean, Elon Musk threw some shade on the call, didn't he? He said, you try and name for me a single automaker in the world, either a pure play EV name or an automaker that has an EV division that is doing it profitably. And his argument was there isn't one. It's just Tesla. And that's probably true. I mean, just in extension of what I was saying a second ago, it's just the basics of running a large industrial global company, right? They have managed to pull down their raw materials costs and refine the production process. And then they benefited hugely from, to your point, John, regulatory tax credits, right, which they sell and the other automakers have to buy from them. Why? Because the other automakers aren't doing a very good job at selling EVs. And it's sort of a self-fulfilling prophecy in that sense at the moment for Tesla.
Ed, you were on the call, and I know that Elon Musk talked about the factories in Mexico, and he said, we're going to make a decision. We have to wait for the U.S. election. He's talking about China being this growth driver. That's what Dan Ives told us yesterday. How much actually is Elon Musk waiting on this election where he supports the former president, but potentially the former president's policies actually might hurt him at Tesla?
Yeah, Anne-Marie, I'm really glad that you asked. And if I may, I wrote about this in the moment on the call because I felt it was really important. Musk did not name Donald Trump and he did not use the word election. But what he was saying is that he wanted to see a federal level or nationwide regulation for autonomous vehicles. Tesla is currently pivoting its entire business toward that. And what he went on to say, quote, is that if there is a Department of Government Efficiency, end quote, then he would work to enact federal and nationwide regulations. For me, that is the CEO of a large publicly traded company saying that if the candidate that he is a backer of wins, then he is going to use that platform to enact and push for federal level regulation of the business line his company's entire future is pegged to. And I thought that was critically important.
Ed, a key piece of this puzzle at the moment is China. So let's talk about China and what it could mean for Apple. You've seen the downgrade that came from KeyBank this morning, downgrading the stock to underweight from sector weight. I'll share the quote with our audience who might have missed that this morning. Apple, an impressive business with what we believe are unrealistic expectations to re-accelerate growth across all product categories and geographies. What do we know about what's happening in China this quarter?
Yeah. I mean, the hard lesson I've learned in the last year, maybe 18 months, is one, be wary of the third-party data about Apple sales in China, because when earnings roll around, we're often proven wrong in some sense, right? You can definitely see that competition for Apple in the smartphone market in China is there and that it materializes in their top-line growth. But also, two, we don't understand what's happening, frankly. There is a phenomena where Apple is selling the iPhone 16 in China, and there is some evidence that the consumer is buying it on the belief that in the future, Apple will roll out its artificial intelligence technology there. But it's not currently available there. The regulators won't allow for it, and Apple isn't deploying it. But it's a really interesting consumer behavior that is impossible for any sell-side or third-party researcher to track, because it's a consumer betting on a future product that we don't have a timeline for existence. And when they roll around, that's when we'll get the iPhone 16 data, the real data from Apple. And I suspect that it will be interesting to see if iPhone grows and other categories from Apple in China do not, as has been the case in prior quarters.
So, Ed, there is zero timeline for when those individuals, those consumers in China that decide to buy this iPhone are going to get access to the AI technology?
Yeah, I mean, the notable story of this week, of course, was Tim Cook being in China and meeting with relevant government officials who are part of that regulatory body. Apple has a unique position for a US company in China that maybe only Tesla also shares, that it moves with relative freedom, both in its end market for sales, but also in its supply chain. But they can't decide when they deploy a technology like this, Apple Intelligence. It's at the whim of regulators. And as we know, particularly in the context of video games licensing, for example, regulators can change their mind very quickly, or they can take a very long time to do something. Modeling for that is very hard, though I'm not a sell-side analyst. I'm a journalist.
Well, you mentioned Tim Cook. He met with the Commerce Ministry of China today. He's also been on these tours, taking these selfies. You see how government leaders are reacting towards China versus business leaders. Look at the way Elon Musk and Tim Cook react towards China, but look at the way the two leading parties in the United States, the Democrats and the Republicans, bipartisan support for talking tough on China. For Apple, what does the future look like if we get a Trump 2.0, which is being priced into the financial markets?
Yeah, I don't think we know that answer. I mean, interestingly, what I took from that recent interview with Micklethwait was basically Trump feeling that he has a good relationship with Xi and a good relationship with China, and that he would do something in American interests. But we have been through one Trump presidency, 2016 through 20, where other than that sort of latter part of the pandemic that muddied the waters, Apple was fine. It has de-risked its supply chain to a certain extent, shifting some production to India and other parts of Southeast Asia. But critically, and it is relevant to NVIDIA as well, right, in the context of export restrictions, China is still the most important end market for everything from consumer electronics right through to data center and hyperscalers. And so we watch it closely, what Trump will or won't do. I think that's part of the problem. We don't have a clear sense on the policy platform of either when it comes to technology companies in this country.
Ed, massive week ahead. Looking forward to covering it with you, sir. Ed Dutta. On the West Coast, you can watch Ed every weekday on Bloomberg Technology at 11 a.m. Eastern Time alongside Bloomberg's Caroline Hyde. Tim Cook proved to be a really effective diplomat throughout Trump's first term. And what we heard with Howard Lutnick just a week or so ago on this programme, we talked about whether Apple would get carve-outs if they went big on tariffs, and he said no. And I wonder if he's going to ultimately change his mind once again.
Yeah, Lutnick said no one's getting a carve-out, not even Apple. Donald Trump has talked about the fact that Tim Cook would call him and say, look, this is what I'm dealing with in the European Union. This is what I'm dealing with China. Can I come in and walk you through this? And actually that personal touch from an executive was really important to Donald Trump, and it ended up being beneficial to Tim Cook.
Apple just a little bit lower this morning. We're down by 0.5%. The earnings coming up next week. Coming up next on this programme, we'll catch up with Stephanie Roth of Wolfe Research, looking for 70K on payrolls next week. And we'll speak to Sonia Meskin of UBS. From New York, this is Bloomberg. 60 minutes away from the opening bell. Equity futures this morning up by 1/3 on the S&P 500. On the Nasdaq 100 up by 0.4. With an hour until the cash open, let's get you some morning movers with Manus Cranny. Morning, Manus.
Jonathan, a very good morning to you. The pain trade on Wall Street this morning is for the merger arbitrages. This is Capri down. Their lifeline, the merger with Tapestry, is taken off the table. Now, what does this actually do? Because this leaves this company exceptionally vulnerable. Think of the brands in there, Michael Kors, Versace, and Jimmy Choo. Where can they go to next for funding? You're going to see Tapestry at the bottom of your screen. A lot of people are saying, look, this is an escape for Tapestry. In other words, they're not going to be dragged down by these discounters, and indeed it emboldens their position. But if you want to get to the size and scale of Louis Vuitton and Kering as in Europe, you need to be able to do deals, and that is the drag potentially in the longer term for Tapestry. Size and scale is everything in luxury. Capital One, let's have a look at it. They have delivered numbers which were better than you saw from Ali Financial last week. Cards, auto growth, and credit losses down by over $1.4 billion. That gives them a little bit of a kicker this morning, which takes me to Skechers. The stock is up this morning 7.5%, 30% growth in EMEA, which was unexpected. They tanked and kitchen sinked everything back in September. They warned on China. And of course, there's a collection from Snoop Dogg, which you can get your hands on, Jonathan. I've got you down much more for Laura Piana, kind of Axel Aguito kind of guy.
That's a good read. I would say that's a good read.
Laura Piana.
I don't know a single person who wears Skechers. Nobody. Do you know anyone who wears Skechers?
I think for a while President Biden was until he went into Hoka's.
Okay.
But I think you're more Brunello.
I think that tells you everything you need to know about that brand right now, but they seem to be doing well. Unexpected strength is what Barclays said, and I have to say it was unexpected to see. Manus Cranny, thank you. And Manus Cranny wouldn't be seen dead in Skechers either.
No way.
Let's be very clear about that, OK? Let's talk about payrolls. Stephanie Roth of Wolfe Research saying this. We're looking for 70K on payrolls. Despite being bullish on the economy, we expect significant noise in the report. Stephanie joins us now for more. Stephanie, good morning.
Good morning.
You are bottom of the survey here at Bloomberg, and I think that was unexpected for you, 70,000. So I know you're not bearish. So let's just start with the 70 and tell us what's gone into that. What's the process that you and the team went through? How'd you end up at 70?
Sure, it's actually kind of simple. So the trend in payrolls growth is somewhere around 150,000, right? So that's a decent trend in payrolls growth, similar to where we were last cycle. Then you've got to knock out 33,000 from Boeing. And then our estimate for the payroll for the payrolls impact from hurricane is about 50,000, which is in line with historical hurricanes of the past. So that gets you to something that's pretty weak, even though the underlying trend is just fine.
So claims came out yesterday. They're back to pre-hurricane levels. What does that tell you, if anything at all, about what we might see next week?
Yeah, so you saw about 4,000 increase from Florida. It's possible you'll see another increase for next week. If not, then it might tell you that our number's a little bit low and the hurricane had less of an impact than we thought. But even you had Governor Waller the other day out saying the combined impact from Boeing and the hurricanes could be 100,000.
Stephanie, what if you add in the basic revisions that people now slice off the non-farm payrolls report because we know about the data being difficult and noisy? Say you take 60,000 off. Is that included in your 70? Or if you take 60,000 off, maybe we'll get 10,000 for the NFP?
Well, so one thing to note is that in the revisions, and we saw positive revisions in the last print, we should probably see positive 2-month revisions in the next print as well, because you typically get positive revisions in the month of August and September on both the first and second prints.
Sounds like you think 70 is actually a good number for next week. Is that a good number?
I think it's fine because if in fact the hurricane number is kind of correct, when we look at the state data and we can confirm it was driven by Florida, then it's totally fine and the market shouldn't be scared of it.
What's the kind of number the Fed might be scared of? And by scared, I mean sit there and say perhaps we shouldn't cut interest rates by 25 basis points.
I mean, I think they could take Governor Waller's number, 100,000, knock that off the trend. So call it something below 50,000 would really get a lot of attention. The BLS also publishes the number of strikers, so you can easily add that one back.
No, I'm asking what would stop them from cutting at all, not going from 25 to 50. What would make them sit there and say, this jobs market is way stronger than we thought it was. Unemployment was climbing through the summer. We got nervous. We did a big Jackson Hole speech with Chairman Powell, came out and cut interest rates 50 basis points. Here we are, a few months later, 10-year yields are up by 60 basis points, and the 2-month average for payrolls is 200K. Should they be cutting interest rates?
Oh, it's such a tough one. I mean, I think it's really hard for them to not cut in November. In December, it's fairly likely they'll skip. So I think they'll probably just want to see a little bit more data. And then by December, it's very reasonable that they would want to pause for a meeting.
But Stephanie, he's asking for a number. Is it 200,000? What is that number look like?
Yeah, I think it's 200,000.
The line in the sand.
That's probably the line in the sand.
But you think that skip might come in December?
I think it's more likely December than November. But it's fair. I mean, and you should also start to see a little bit of headwinds from an inflation perspective from the hurricanes. That starts to put a little bit of upward pressure in the next couple months.
So your number for next Friday is 70, but as we said at the top, you aren't bearish, you're bullish. So walk me through what you're looking for through year end and into next year. What do these numbers look like for jobs, for inflation, and ultimately for the Fed's landing?
Yeah, so for jobs, we think that the trend is that 150,000. Forget about the next print that's filled with a lot of noise. But beyond that, something like around 100,000. We're looking for soft landing type prints, so inflation roughly around 2%, probably a little bit above, and you'll have a little bit of upward pressure in the next couple months just from hurricanes, so autos should see some upward pressure. That's a soft landing type of economy. We went from over the summer thinking it was hard landing, then the market narrative was soft landing, then it became no landing, and the result is probably somewhere in the middle where it's soft landing. That said, the no landing has probably not run its course yet. We're not quite out of the woods from that.
What does that mean? What does the no landing hasn't run its course yet? What does that mean?
That there's still probably upward pressure on rates in the near term. Combination of election uncertainty, pricing in the potential odds of Trump significantly raising up the deficit, and realistically both sides putting upward pressure on rates. So the no landing, I think, really manifests itself through interest rates. So that's probably where we would see it in the near term.
So in the near term, maybe the Fed holds in December. But how are they thinking about 2025 when you see the policies on the campaign trail?
It's a tough one. As of now, it's probably like an every other meeting type of pace until they get to something that's close to 3%. But it's a challenging one. And by the way, tariffs are, yes, they're inflationary, but they're also significant headwind on the economy. So chances are they're not going to be more hawkish on the back of that. If anything, they'll have to be more accommodative, or it just will keep them on pause for a bit.
The market right now is pricing in not just Trump, but potentially a red sweep. Tariffs. Trump can do that on day one. If he was to go there and start pulling the levers on tariffs, how does Jay Powell continue on a cutting cycle?
First of all, we do think he'll do it a little bit later in the year, closer to when they have to extend TCJA, in which case they can kind of tie those things together, the revenues that you're raising as a result of the tariffs. But let's just say, fine, let's say they do it at the beginning of the year. We think that could be an upward pressure on inflation by about a full percentage point at the least. I think the Fed's going to have to wait for a little while, kind of see how things shake out. Realistically, it'll probably hurt growth, in which case they're actually going to have to be more accommodative rather than less.
So just to wrap it up, where do you think rates are coming down to through next year? I know it's super hard to have a base case without really knowing what policy looks like through 25, but what is your base case for 2025?
On Fed funds rates?
Yeah.
Yeah, we think there'll be about 5 more cuts from here by the end of 2025.
OK. And they skip December. That's the base case or just a possibility?
Somewhere in between.
OK, we're not quite there yet. Stephanie, appreciate it. As always, thank you. Stephanie Roth of Wolfe Research, trying to work out what was published and what wasn't published just yet. Equity futures on the S&P 500 look like this. We're up by 1/3% going into the opening bell. The opening bell is about 50 minutes away, with the Nasdaq 100 up by 0.4%. On a Russell, we're up by about 1/3. In the bond market, lots to talk about. This week on a 2-year and a 10-year, up by double-digit basis points so far through yesterday. We come back just a little bit. We're down 3 basis points on a 2-year to 4.05%. On a 10-year, we're down by 2 to 419.40. And on a 30-year, we're up to about 446.32 and down a single basis point on the session so far. Joining us around the table, Sonia Meskin of UBS. Sonia, good morning. It's good to see you. Here. Just had a conversation with Stephanie about payrolls next week. Base case for her, 70K. If you've got a base case, and how difficult is it to just pick a number out of the sky and roll with it for next week?
So tough, and we've talked about this before, actually, on this program specifically. The report that we got last time was probably the last clean report for the year, given all these hurricane effects and such. And Waller came out recently and said, look, this next report can be down by 100K just from the weather effects. So we just think that the Fed is going to have to look through this one-off weather impact, as horrible as it is for the communities that are impacted.
And as you know, this Treasury market has been doing much of the same thing, leaning on retail sales. Upside surprise, jobless claims back to pre-hurricane levels. We've said that repeatedly through this morning. And we've had a move on a 10-year of something like 50 to 60 basis points since the Fed cut interest rates by 50 basis points. What's driving Treasuries right now for you? Because the debate we've had on this programme, data or politics, politics or data, a mix of the two or one or the other?
We think, look, it's 3 things driving rates right now. Uncertainty around inflation, uncertainty around near-term growth with the fiscal trajectories from both candidates, and the broader fiscal trajectory of the United States that may potentially come more into focus as we near the election.
I'll speak to political strategists who say the proposals Donald Trump has right now and he's putting out there is worse for the deficit. You don't think that's true? You think both camps are pretty bad for the deficit?
Well, so we actually differ a bit from consensus here. We've done some modeling around this, and we think that Kamala Harris would probably extend the deficit by about $2 trillion, whereas Trump would extend the deficit by just over $4 trillion. In the grand scheme of things, in the wall of the entitlements that are coming more and more into focus for the markets, and also the TCJA extension, and then the immigration policies that would impact the labor market and therefore inflation and growth, we think that those differences are actually not the biggest.
So do you find it odd that the bond market is pricing in Trump?
Well, we think that, over the weekend, for example, we saw him improve in the polls. And historically, Trump has done a bit better in elections than polls have shown. So it's not exactly unusual that the market is giving him more credence right now.
Do you think we're well priced for it in the Treasury market? Because we've gone back and forth on this a lot. There is a massive difference between a Trump presidency and a full GOP sweep. And I've heard from the likes of BMO's Ian Lingen, who suggested that outside of a GOP sweep, it's difficult to see 10-year Treasury yields anywhere between 20, 30, 40, 50 basis points higher from here. How well priced do you think we are for either scenario at the moment?
Well, we think that fundamentally, if we start pricing in a wide deficit, like 7% of GDP going forward, while we're growing at, say, a trend of nominal 4% GDP, if this is not a good trajectory, this is going to drive the term premium up in and of its own, right? And there's going to be a crowding out effect in terms of growth. Then on top of it, we have the debt ceiling coming up, which can be punted further by Congress, for example, into next year, but increases uncertainty, therefore, for businesses and households. So there's lots going on in the Treasury market right now.
When you rank 2025 and the concerns, is it debt ceiling, TCJA, then tariffs? What gives you most the cause for concern?
Well, the tariff scenario is actually a very interesting scenario because tariffs only on China would actually not, in our modeling, have as big of an impact on the U.S. economy specifically as all-out tariffs.
Why?
Well, because all-out tariffs there would be much less of a substitution effect and more potential retaliation from the trading partners. So it's really a stagflationary environment, and that would be quite impactful.
But wouldn't China retaliate?
China would, but they're a smaller portion now of our economy. The interaction with them is a smaller portion of our economy than pre-COVID. There's been a lot of a substitution effect already.
We know how much this would hit Europe, and we've started to see a big divergence, a gap open up between the German 10-year and the US 10-year as well. Are you expecting some form of divergence through 2025 between the US and Europe, across growth, across rates, across central bank policy?
Well, we've had some divergence already, right? Other central banks have started easing a lot earlier than we have, and we've had stronger growth. I think one of the differences that we do see going forward, potentially, is what happens with inflation. Because we see inflation actually surprising to the upside into the first quarter of next year. And whether this happens in Europe or not, for example, is a different story. We also think, interestingly, that part of the decline in inflation globally has been not necessarily a central bank phenomenon. So that means that it's actually more difficult for central banks to control if we see upside surprises as well.
It's a really, really important final point. Sonia, it's great to see you. Sonia Meskin there of UBS. We've talked about this a few times. I think just to make it really, really simple, think about how the conversation has changed. In America, we've gone from talking about 25 or 50 to 25 or nothing. And in Europe, they've gone from meeting to meeting, 25 or maybe not, to 25 or 50. The two conversations in Europe and the United States have just completely reversed over the last month.
And you think about it, whose job actually is easier? I know Donald Trump liked to make a joke about it's the best job in Washington. You flip a coin, it's the easiest job. Actually, Jay Powell probably has a harder job right now, given how much the data is muddled. How easy is the job for Christine Lagarde? You have to cut. The growth environment is not good, and inflation is coming down.
Chairman Powell is going to have such a difficult news conference if we do not have a result from the US election. He's going to have question after question about policy, and he's not going to be able to answer it. Equity futures on the S&P up by a third of 1% with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. With just 11 days until the election, Kamala Harris is leaning into celebrity endorsements. The vice president was joined on stage for the first time by President Barack Obama. At a rally in Georgia, she was also joined by Bruce Springsteen. Later on today, she'll be joined by Beyonce at a rally in the singer's hometown of Houston. Microsoft CEO Satya Nadella received a pay package worth more than $79 million this year. That's a 63% increase from the year prior. According to regulatory filing, about 90% of his compensation was in Microsoft shares. The filing also showed his package would have been about $5 million higher had he not requested a pay cut to reflect his personal accountability for the changes the company is making to reflect cybersecurity risks. The New York Yankees and the Los Angeles Dodgers face off tonight in Game 1 of the World Series. It'll be the 12th time the two powerhouse franchises have met for the trophy, but the first time in 43 years. The series puts the spotlight on two of baseball's biggest stars, Dodgers phenomenon Shohei Ohtani and Yankees slugger Aaron Judge. The Yankees will hope to add to their league record with a 28th World Series title and their first since 2009. The Dodgers are looking for the club's 8th ring and their first since the COVID-shortened 2020 season. And that's your brief, John.
Danny, thank you. Thanks for this morning. Have a wonderful weekend. Up next on the programme, we'll set you up for the week ahead, a sneak peek of next week, and why everybody's seemingly heading to Texas on the other side of this commercial break. From New York City, this is Bloomberg. So let's call it 40 minutes away from the opening bout. The opening bout just around the corner with equity futures on the S&P up by around 0.4% on the S&P 500. On the Nasdaq 100, up by 0.5%. Yesterday, the only positive day of the week so far. Snapping a 3-day slide. Let's see if we can add some weight to yesterday's rally. At the moment, poised for the first weekly loss in 7, snapping a 6-week winning streak, which was the longest weekly winning streak of the year so far. That's the equity picture. The bond market story looks like this. A 2-year, 10-year and 30-year yield through yesterday, up by double-digit basis points through the week so far. We pulled back just a little bit, erasing some of that move. We're down 3 or 4 basis points to the front end. At the longer end on a 10-year, we're down 3 basis points to 418. On a 30-year, a break of 445. 444.95 and down 2 basis points on the session. They're the scores going into the cash open in the equity market. Here's the trading diary through today, into the weekend and through next week. UMich consumer sentiment coming at 10 a.m. Eastern time on Monday. Ford reports Tuesday. The jobs data starts. It's JOLTS data, job openings, plus Google earnings, big tech. So many companies reporting, including the likes of Meta, the likes of Apple and Google. Then going through Wednesday for more economic data, we'll get initial GDP data. On Thursday, another round of jobless claims and core PCE. And then on Friday, it's the big one. It's payrolls. Take your pick next week. AMH, you've got massive tech firms reporting. And then you've got the big payrolls report. The estimate's 120, and the guesstimates out there at the moment are pretty wild.
They're all over the place, and I love how Stephanie Roth at 70K is the lowest on the street, even coming in lower, although she's bullish, even coming in lower than Andrew Hollenhorst, who we know is bearish, and he thinks it's going to be a soft 90K print. And then you have Bloomberg Economics, not part of the analyst survey, but they actually think we're going to get a negative print, negative 10K, because of all the noisy and muddy disruptions when it comes to things like the strikes and the hurricane. The issue is, what if it's a surprise to the upside? And the question that has for where this leaves the Federal Reserve 48 hours after the U.S. presidential election, when they might not know the outcome.
This is how we start the show this morning. Jim Bianco of Bianco Research suggested that maybe the biggest risk for next week in the payrolls report was upside risk. Next week's a massive week. Before we get there, plenty more campaigning to do on the campaign trail. Harris and Trump are in Texas today, betting influential celebrities will help with a final election push. Bloomberg's Julie Fine joins us now from Dallas. Julie, welcome to the program. Walk us through why Texas is going to be so important for the next 24 hours.
Well, it's certainly important for Harris. However, she's got to know she's not going to win this state. But what she wants to do is refocus on the abortion issue. And she believes this is the place to do it. Texas is the state that began the strict abortion rules of 6 weeks. Very few exceptions, with the exception of the health of the mother. So therefore, she really wants to refocus to that. Also, she's got some major Texas star power with her. She will have Beyonce here. She will have Willie Nelson here with her. So listen, she can't simply say, I am not Donald Trump. What she wants to say is this is an issue that is very important to Democrats. I am going to what her campaign is calling ground zero for that. She will be with people that have personal stories about abortion, and she will also have Senate candidate Colin Allred with her. She's hoping to help him in his race. So therefore, this is big for her in that sense, in an issue sense. Let's talk about Donald Trump. Now, Donald Trump has used Texas as a cash register forever, but he has a lot of support here. He had to be here for Joe Rogan's podcast. So what he's decided to do is also use this as a backdrop for him. It has always been a good one when it comes to immigration, which has been a very successful issue for Republicans. So that's why they're both going to be here.
Julie, I'm really looking forward to that Joe Rogan podcast because those two men actually have a little bit of beef. I wish Kamala Harris was sitting down with Rogan because you have to sit for a full hour. And if you look at some of the past episodes, pretty much anything can happen. But you mentioned Colin Allred. I want to talk about that Senate race. Is it actually close? Can he unseat Ted Cruz?
I mean, listen, it is within the margin of error. It is a very different race, Anne-Marie, than the one in 2018 when it was Beto O'Rourke. The only similarity is that they both raised about $80 million, and they have both outraised Senator Cruz. Senator Cruz, by the way, will be with Donald Trump as well. Here's the situation here, though. I mean, you've got to get almost all of the independent voters. I was actually at a Colin Allred event last night. He, too, is talking a lot about abortion because he knows that resonates here. So for him going to be with Kamala Harris, it's somewhat of a difficult move for him because he's tried to run as a moderate very differently than Beto O'Rourke. But in this situation, he needs to be with Kamala Harris. And if he didn't show up, that's what people would be talking about, not the issues. So again, I would say it is about a 3-point race. It really depends on how Donald Trump does in the state. He won by 6 points back in 2020. Now, in 2018, in the Senate race, it was not a presidential year. This time it is. Colin Allred running better in Texas than Kamala Harris is. So you have that to look at. I believe that it is about a 3-point race right now. It really comes down to turnout, and it also comes down to those independent voters, which he is trying very, very hard to get. Also, Anne Marie, which I think you both probably found interesting, Ted Cruz also trying to run as a bipartisan in this race. Now, you know he is a very close ally of Donald Trump's. So it'll be very interesting to see.
Julie, great to catch up with you. Looking ahead to a busy weekend. Julie Fine there of Bloomberg going into the final full week of campaigning.
Well, it's going to be interesting. And I think Evan Roth-Smith nailed it this week, saying it's the shock and awe effect, wanting to get the headlines. Kamala Harris goes to Texas, deep ruby red, and Donald Trump comes to very bright blue New York to play, quote unquote, the Garden.
And it's getting the attention that they were looking for. Tons of attention on those two individuals over the next week or so going into that election in the United States on November 5th. Coming up on Monday on this programme, we'll catch up with Ambassador Ed McMullen. Big conversation with the man himself about his future. Will he be in a future Trump administration? Mike Dutta of Roth Capital will speak to Victoria Fernandez of Crossmark and the Nobel Prize-winning economist Joseph Stiglitz on why he's supporting a Kamala Harris presidency. All of that and more coming up next week from New York City this morning. That does it for this week. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.